My name is Moshe Gubin, and I have the distinct honor of serving as the chairman of OptimumBank. Founded in 2000 in Broward County, Florida, OptimumBank is guided by a mission to provide exceptional personal attention to our business and consumer customers at a reasonable cost. Over the past 4 years, we have experienced remarkable growth, which has paid off by bringing us institutional investors, including AllianceBernstein. Our growth has also attracted equity research coverage this year, and we take big pride in being traded on the Nasdaq under the ticker OPHC. Before we dive into our program, I'd like to take a moment to express my deepest gratitude to the people in our organization that make our business run as well as it does. First, to our CEO, Tim Terry. Second, to our CFO, Elliot Nunez. And lastly, to the incredible team at OptimumBank. And really, lastly, as we say in Jewish, Achron Achron Chaviv, to our dedicated board of directors. Your hard work and commitment have been the driving force behind our success. I also want to thank all of today's panelists for sharing their expertise and insights, and a special thank you to our dear friends at The Real Deal for their support in bringing this event to fruition. Now, it's my honor to introduce a distinguished leader whose profound impact on our nation's economic landscape continues to resonate today. As the former governor of Ohio, John Kasich tirelessly championed fiscal responsibility, job creation, and bipartisanship, earning widespread respect across party lines. His tenure as chairman of the Budget Committee in the U.S. House of Representatives was marked by his pivotal role during the last time our country actually achieved a balanced budget, showcasing his commitment to sound economic policy. In addition to his political achievements, Governor Kasich is a celebrated author and a sought-after speaker known for his insightful perspectives on leadership and governance. Today, we are privileged to hear from Governor Kasich through a special video message. Please enjoy the governor's insights and the rest of this morning's program. Thank you.
Good morning. I'm Governor John Kasich, the former governor of Ohio, and it's my distinct privilege to welcome each and every one of you to the OptimumBank Virtual Banking Conference. It's hosted by Florida Atlantic University. Before I begin, I want to express my sincere gratitude to OptimumBank's chairman, Moshe Gubin, for extending me the invitation to join you today. Your commitment to advancing the dialogue in the banking sector is truly commendable, and I'm thrilled to be with all of you in this virtual intersection where minds meet, innovations flourish, and the future of banking is forged. Your presence here today speaks volumes about your dedication to driving progress and innovation within the banking industry. I want to extend my warmest greetings to each and every one of you who's watching us today. It's indeed an honor to participate in such a gathering of brilliant minds and industry pioneers. As we gather here today, we are reminded of the pivotal role that the banking sector plays, not only in shaping the American economy, but also in impacting economies all around the globe. From facilitating trade and investment to fostering financial inclusion, the impact of banking reverberates far and wide, touching the lives of individuals and businesses alike. This conference serves as a testament to our collective commitment to driving progress and innovation within the banking industry. This morning, you will hear thought-provoking discussions, the exchange of valuable insights, and explore groundbreaking solutions that will redefine the future of finance and banking. From Venmo to PayPal, crypto, blockchain, fintech, this is the dynamic change of banking, and the victory will go to those who understand this and are committed to innovation. The market leaders you'll hear from today will underscore the importance of adaptability and resilience, and of course, in an ever-evolving landscape. As we navigate through unprecedented challenges and embrace transformative technologies, it's imperative that we remain agile and forward-thinking in our approach. Today's conference will feature not one, but two distinguished panels, each of which will share extensive market intelligence. Additionally, we are honored to have a closing speaker, Sheila, the former chair of the FDIC, who played a crucial role in navigating our country out of the depths of the 2008 global financial crisis. Their insights and experiences will undoubtedly provide invaluable perspectives as we chart the course ahead. It is my hope that the information provided today will not only inform, but also inspire the audience, fostering collaboration and driving innovation within the banking and finance industries. In closing, I urge you to approach this conference with an open mind and a spirit of curiosity. Let us embrace the challenges that lie ahead with optimism and determination, knowing that together we have the power to shape the future of banking for generations to come. Thank you once again for permitting me to join you on this journey, and may this conference be both enlightening and inspiring for everyone.
Thank you, everyone, for joining us today. I'm Tim Terry, President, CEO, Optimum Bank. I'm excited to introduce our next segment titled Navigating Global Economic Trends, Risks, Opportunities, and Banking Insights. This panel features some of the most respected voices in economics, finance, and market analysis. We're honored to have with us Daniel Lacalle, a renowned economist, fund manager with deep insights into global markets. Phil Mackintosh, Chief Economist at Nasdaq, who brings a wealth of knowledge on market structure, economic indicators, and Gareth Soloway, a seasoned trader and financial educator, who will offer a unique take on market movements and strategies. Unfortunately, David Rosenberg cannot join us today. However, we are pleased to welcome Dylan Smith, who serves as the Senior Economist at Rosenberg Research, where he leads the economics team, focusing on developing macroeconomic insights and thematic research. Prior to joining Rosenberg Research, Dylan was a Rhodes Scholar, also worked at McKinsey & Company and Goldman Sachs. Guiding our discussion is Mandeep Trivedi, a managing partner at Citrin Cooperman. With over 20 years of experience, Mandeep specializes in complex business valuations, financial analysis across various industries, including hedge funds, technology, and entertainment. Please join me in welcoming this exceptional panel as they explore the risks, opportunities, and insights shaping the future of banking in an ever-changing global economy.
Thank you, Terry, for your kind introduction of our panel this morning. And thank you to Florida Atlantic University for hosting this conference and to Optimum Bank for organizing it. We are very excited to have this esteemed group of professionals and thought leaders here to share their thoughts, experiences, and outlooks on how to navigate current global economic trends. We're going to be talking about the opportunities that exist, risks, and overall banking, investor, and business insights. There is much to discuss and only a small window to do so. So let's just jump right in. This is a banking conference. So Daniel, let's kick off with your thoughts on key global economic trends that banks specifically should focus in on in the next 12 to 18 months.
Thank you very much. Thank you for inviting me to this conference. And what I think that investors should be focused when they're looking at the global economy is to pay less attention to headline figures like GDP and core inflation or headline inflation, but to the trends in manufacturing, in services, and also the trends in trade. I think that we have seen a number of improvements in the global economy, but we have to understand that this 2024 was a very challenging year. It was a very challenging year because it's been a year of elections. We've seen more than 70 countries have elections, and what that means is a lot of governments spending way too much money in order to get elected. So what we need to understand is that 2024 GDP trends need to be at least adjusted for the enormous accumulation of debt. Therefore, what I would try to highlight for everyone is, number one, look at what is happening with commodities. It's showing how negative the manufacturing trend globally is. Look at what is happening with services. That doesn't last forever. The services sector is in strong expansion in developed economies, but it's happening also in a time in which the accumulation of personal debt is very significant. So geopolitical risks and trade tensions are eroding potential economic growth. This leads more to an environment of secular stagnation than recession or crisis. The reason why we are not seeing a recession or that we are not seeing a crisis is very simple. is that although central banks have given a message of being exceedingly hawkish, in fact, what they have been is exceedingly accommodative. And therefore, liquidity has not been a problem. Government spending has continued to rise quite significantly, etc. So I would focus on not expecting a crisis and not expecting a recession, or at least what citizens and market participants perceive as recession, which is not 2 quarters of negative GDP, but a prolonged period of economic stagnation and decline. I think it's going to be more a period of low growth, persistent inflation, precisely because governments and central banks continue to be way too accommodative in terms of spending and in terms of money creation, and also significant differences between economies. The euro area in a persistent, the ECB just downgraded its estimates for 2025 and 2026, persistent stagnation. In the case of the United States, a more robust level of growth, but also very driven by public debt. And in terms of the emerging economies, Asia continues to be the driver of growth for the world, while Latin America is unfortunately falling yet again into another decade, a lost decade of virtually no growth and very little improvement, relative and in absolute terms. The frontier markets will likely continue to deliver growth, but the challenges come on the monetary side. So I would continue to expect the dollar to continue to strengthen relative to most currencies around the world, with a negative environment for the purchasing power of most fiat currencies globally.
Thank you, Daniel. Gareth, I saw you nodding your head a few times. What are your thoughts on current economic trends impacting the banking community?
Yeah, so thank you for having me as well. It's wonderful to be here, and so I agree with what a lot of what Daniel's saying in terms of the struggles that we're likely facing, and really why we haven't seen a recession. I mean, you look at the U.S. debt, you look at global debt, you look at the ease of the Federal Reserve, and I mean, while we're coming off a tightening phase, I think it's important to keep in mind that even during that period, there were still emergency lending facilities for banks that they were able to utilize, and many of these other things. So it really wasn't as tight monetary policy as maybe it seemed, even though the interest rates jumped so much. And I do agree as well is that I think we're going to see persistent inflation. You know, you look at where we've come back to, we're back to about 2.5% via the CPI yesterday, but now you're into a new phase of loosening monetary policy, and we're starting from a much higher level. And then you still add in the political spend, the government spending that has continued to go, and there's really no fiscal responsibility talk out there at this point. I mean, very few. No party wants to take that on, because what do they know? They know that to get it under control, it's going to create a big economic struggle for the country, right? I mean, you have to raise taxes, that's going to be tough, and you'll have to cut back on spending. And both of those will have an impact on the economy. So what politician wants to be in charge of doing that one, especially at these current levels? So it's a tough situation. You know, a couple things that as the banks go, if I was running a bank, I'd be paying attention to what the central banks are doing. They've been loading up on gold. I think that tells us a lot in terms of what they see coming. It's kind of like if you have the keys to the castle and you're doing these type of things, it's like, okay, we need to be aware of those situations. So I think those are some of the issues that I'm kind of foreseeing, kind of a drawn out. I'm not necessarily looking at a recession that's as bad as the financial crisis in the near term over the next year or two, but I do think we could get into this persistent low growth period where it's just a struggle for a lot of regular folks out there.
I'm curious what if any of these trends will affect investors more than banks. What your thoughts might be there.
Yeah, you know, I think it is interesting, right? So I think as of now, we're seeing the consumer, at least in the U.S., being affected more. We're seeing delinquency numbers rise substantially, and I think that's something that's affecting at least the investor, well, the consumer at least, maybe not the investor yet. But I do think that, if you look at the stock market, and that's what I mainly trade, is that we've had these high valuations on these mega cap companies, an over allocation of capital into many of them. And I think these are risks. Everyone is assuming the Fed will bail us out, right? Everyone is assuming everything will be okay because the Fed has always bailed us out, at least since 2009 and arguably before that. But I do think there's a point where the debt levels get to a level where the market takes control of interest rates. And that's the thing is, does that happen in a few years? Does that happen in 10 years? I'm not sure. But ultimately, the market will eventually control the Fed, and the Fed won't be able to control interest rates. And that's really where you could see this massive unwind. Part of my investment strategy for myself is to start looking at other areas of the world where they're rich in commodities, rare earths, and even China. China's an intriguing area based on the valuation. Granted, there are risks, and I know we'll get into that in a little bit. But definitely for investors, I think the valuations in the U.S. are a little stretched.
Phil, would you agree with that, or do you have a different perspective?
I mean, I think what's interesting about the cycle is the outperformance of the US market has really been driven by those Mag 7 stocks. And the Mag 7 stocks are earning real revenues. So it's totally different than the last tech bubble. We've got real solid margins in those companies. We've got real growth, real revenues. So it's not like the profitless bubble that we had in sort of the 2000 era or the 99 era. When you look deeper down, though, really a lot of the S&P 500 is not growing as quickly as those companies. It's an AI trade. It's people that have cloud. It's people that have chips. It's people that have artificial intelligence that are actually growing revenues. The rest of the complex is growing much more slowly. And then as you drill down into mid cap and then small cap, what's interesting is those are the companies that are actually getting hurt by these higher interest rates. So it seems like the consumer has remembered everything that happened in the credit crisis and gone and locked in 20 and 30-year fixed rate mortgages. That means the monetary policy hasn't really translated into the household sector, which I think has been why spending has held up, because no one's paying that much more on an interest on a mortgage rate anymore. But the company side, large cap haven't had that impact, but small cap have. So small cap margins have been crimped. The percentage of their revenues that are being taken up by interest now is pretty close to like multi-decade highs. The only really time it peaked above that was during COVID, and that was because earnings plunged, not because interest costs went up. So really, the small cap complex, it's underperforming right now because it's paying a lot more interest and its profits are actually in a little mini recession already. So when you look at what that's done to the economy, a lot of those small companies hire a lot of people, and a lot of those companies are actually a lot less positive on future hiring. So for me, I think I would worry a little bit, especially as a bank, about rates, but also about jobs. Because if the consumer starts to see layoffs increase, and admittedly, layoffs are pretty close to multi-decade lows too. But if you start to see layoffs increase, then I think the credit quality and the defaults that Gareth talked about could get a lot worse. At the moment, the total leverage of households is relatively under control. Even credit card debt as a percentage of income isn't back to previous record levels. But as we start to see job losses increase, people's confidence could fade. And then I would also focus on rates, because rates have distorted some parts of the economy. They've obviously affected small cap companies, but they've also affected the housing market. So, like we said, a lot of people are paying basically the same mortgage rate as 3 years ago because they've got locked mortgage rates, but that means no one can move house. And so we've seen a lack of supply in the housing market. That's made house prices go up, which has made housing unaffordable, which has made rents go up, which is part of the problem with inflation, because a lot of the inflation, the sticky inflation story that Daniel and Gareth referred to, is housing. So I think if rates start to come down, which we're expecting next week, and if they come down relatively quickly, you could start to see houses coming to the market as people finally pivot out of the house they own to the house they want to own. A bit more supply might actually make it easier for people to get out of renting and start to get into buying, because the mortgage cost will go down because rates will be lower, but also the amount of supply will come through. And I think you could actually see banks starting to increase on the loan side of the books, because the problem with having no sales of secondary houses is there's no new mortgages being created either. So with deposits at 5.5% and the average mortgage rate at 4%, for a lot of banks, that's been quite stressful. It's a negative interest margin, obviously. If mortgage rates can come down and we can start to actually issue new mortgages at higher rates, and deposit rates come down at the same time, you might actually start to see a little bit more creation of positive interest cover mortgages, which will be good for banks. I know this week JP Morgan, among others, have said they're not going to earn as much interest income. But on the flip side, I think operating a bank and actually issuing loans and mortgage loans that are earning you more than your deposits is going to be a positive for banks going forward.
Um, I'm looking forward to diving a little bit deeper into the conversation on interest rates. Before we shift in that direction, I would really like to get everyone's perspective on, at the end of the day, we are always living in interesting times, but it seems to be more interesting than not these days in terms of geopolitical tensions and the impact that they are having on economic trends. Daniel, can you, from your perspective, speak a little bit about these geopolitical tensions and how they are impacting some of the trends that you articulated earlier?
Yes, thank you. Geopolitical tensions have a very significant impact on the global economy. Basically, they erode economic growth and trade, and they tend to do it for a more prolonged period of time than what markets sort of keep interested in these geopolitical tension problems. Usually what we see is that it takes between 3 to 4 years to recover the trend of economic growth and of trade in the economies that are subject to significant political tensions. No? So I think that basically what that leads is for markets usually lose track of geopolitical tensions once they have stopped being headline grabbing things on a day-to-day basis. We have stopped worrying about Ukraine, about the Israel attacks. We have stopped worrying about so many different conflicts that are shaping two elements. Number one is that we are going to continue to see a higher level of dispersion and of tensions between economies, so more polarization and lower levels of, let's say, global cooperation. Second, erodes economic growth and trade. But third, I think that's one that people tend to give less importance to, is the monetary destruction that these geopolitical tensions create, because they shift massively the confidence in the fiat currency in the countries that have suddenly to be exposed to two very negative trends. One is a decline, complete slump of tax receipts or of export revenues, and the other one, a very significant expenditure growth. So those elements should be taken into account, no? Lower economic growth, lower trade growth, and a monetary debasement that sometimes gets overlooked.
Thank you. And Dylan, from a fundamental economic perspective, what is your take on these global geopolitical tensions and the risks and potential opportunities that they create?
Thanks, Mandeep. Yeah, I mean, I think you're absolutely right there to point out that there can be opportunities too. I mean, I think it's too easy to get very negative about kind of the state of the world and these rising geopolitical risks. So I think it might be worth pointing out where the opportunities lie and how, positioning smartly against some of these trends can actually help protect investors' portfolios. So a few things I'll point out there. I mean, the first and largest, probably most long-term geopolitical trend we're looking at is this idea of a repolarized world, right? So balance of power shifting away from the unipolar US, with China being the main riser on the other end of that, and a gradual ratcheting up of political tension between the two countries, which will inevitably and is already affecting economic relationships. And so what that's causing, and I saw this a lot when I was in the kind of McKinsey world looking at individual businesses, but you can feel it now on a macro perspective too. You're getting news out of Germany to this effect. Companies are starting to rapidly realign their value chains. And the big shift in sort of the past year has been that we're looking a bit less at China plus one type strategies and more into just disinvesting in China completely, right? So that's expensive, and I hear everyone who's worried about that being sort of one of the factors behind a global sort of higher for longer inflation kind of outlook. We actually think there's lots of reasons cyclically to be quite positive about inflation, but I might get to that later. The winners that generates are essentially everyone who benefits from the redevelopment of those value chains in new places. So we would point out places like, in terms of the U.S. sphere of influence, Mexico benefiting enormously, very likely to have renegotiated NAFTA kind of in a favorable way to do that. And we're seeing, historical highs on the peso, Mexico becoming the U.S.'s largest trading partner for the first time in decades. And so this is the type of thing we need to look for a little bit more globally as well. And where we're most positive here is South Asia, and especially India, who is making an enormous push to develop manufacturing capacity at just the right time to start filling the void that's going to be left by China. We also like, in the more sort of advanced space, we think there's an opportunity for places like Japan to jump on that trend if they play it smartly, right? So never forget that, with big change comes winners and losers. The other one I'd point out is the kind of, more worrying trend towards generally more conflict globally. We're seeing it in the Middle East, obviously Ukraine. Looks like Georgia might be next. Now, the obvious winner from that, unfortunately, is defense stocks and the defense and aerospace industry. And we've seen some massive outperformance there. We don't think that's going to go away, and I think any well-diversified portfolio would have that as part of it. The other sort of background force here, and Gareth touched on this too, is that it's very hard to look at gold and not want to hold on to gold, even though it's been one of the best performers of any market this year. There is nothing standing on the way of gold moving up and up and up. We're seeing central banks buying gold as they look to trim their holdings of different foreign currencies. The debate over whether the Chinese yuan is going to be a sort of second reserve currency is effectively done. And so, reasons to both tail off dollar holdings and holdings of other currencies for many central banks. That's a persistent long-term force that will play out for the next few years. But on top of that, the more geopolitical risk rises, and the more you get, as Daniel said, monetary debasement as a result, the more you want to hold onto hard physical assets. And we think that's going to really put a lot of wind in the sails of gold prices going forward. So I think I'll leave it there, but might come back to it.
Since you're wrapping up there, so I think, and we'll get into that. And I would like to circle back to where Phil was leading us into that conversation about the big two I's, interest and inflation. So if we could talk about interest from a global economic perspective, Dylan, how do varying global interest rate policies affect the market?
Remuted myself a bit early. Yeah, look, I think to answer that question, I have to sort of outline how we see the world, which is looking backward, very similar to, I think, what everyone else has diagnosed. The reason we haven't been in a U.S. or global recession, largely to do with enormous fiscal stimulus. Also, U.S. consumers being very happy to spend down their pandemic era savings and even take on very high amounts of credit to sort of do this comeback spending that we haven't seen in other countries like Canada, like Europe, where the economic outlook's been a bit more shaky and people have been holding on to their savings. Now, we think we are entering a period of much slower growth. Our base case is that growth becomes technically recessionary in the sense of what an MB would define. That doesn't mean it's going to be the type of crisis we would have seen in 2009. Whether it tips into recession or whether it's just below trend for a long time, the important point that we're emphasizing is that it is incredibly disinflationary. We see a lot of slack rising in labor markets. We see a lot of slack rising in the global manufacturing industry, which is in a big slump. And so really we see an underlying sort of background of very steeply disinflationary force from a macro perspective. And we also, in line with what Phil was talking about, see the last vestiges of services sector inflation, especially in the U.S., kind of falling out as housing markets rebalance and rents are able to readjust. And so, looking at that backdrop, we think there's there's too much fear still over inflation. We think, we're going to be in one of these situations again where everyone's fighting the last battle when it's done already. And when that realization kicks in, we're going to see rates fall very, very fast, particularly in the US, where we think they can normalize and probably go through neutral within a year to 18 months, right? That we think creates a lot of opportunities in various places, but it also creates that pace will be different. And so, the areas we think will lag on that, places like the UK are going to outperform in from a currency perspective. We're very long on the yen for the same reason. And so, we have rates coming down quite fast, and that affects the asset price mix a lot.
What are your thoughts on varying global interest rate environments on the investor markets and companies in specific?
Sorry, Mandeep, I lost the first part of that. Was that directed at me?
Oh, sorry, Phil. I wanted to pull Phil into the conversation to get his thoughts on specifically the varying global interest rates and how that impacts the investing community.
Yeah, I mean, I think obviously the US has got some of the higher interest rates in the developed markets now. But like we said, a lot of the companies in the US have, especially the large companies, have long-term fixed rate debt. So actually the monetary policy hasn't transferred as well as it used to. So the households don't have that much exposure, at least through their mortgages, to the interest rate hikes the Fed's done. The large cap companies haven't had that much exposure to the interest rates. I think the real risk is if we are higher for much longer, people are going to have to start to refinance some of that fixed rate debt. And so it's stressing the housing market in a different way. But from a company perspective, a lot of small cap companies do have debt to refinance in 26, 27, 28. The other factor that we haven't touched on is things like commercial real estate. Commercial real estate is a lot of things. It's warehouses, it's data centers, which are going really well, but it's also offices. And this whole post-COVID era, at least in major cities, a lot of people aren't coming back to the office, at least not 5 days a week. And so for buildings, if they have to refinance to higher interest rates just when their tenants are downsizing to half of the amount of real estate footprint, there is a risk, I think, that the office space starts to really see some, credit exposure. And that's obviously a bank risk. If you look at what's going on in the sort of behind the scenes, though, a lot of the leases seem to be 5-10 years. A lot of the building finance seems to be 5-10 years. And so we may be able to muddle through on this, especially if rates do actually come down to levels where, a lower lease plus maybe businesses growing into the spaces. So there's a little bit of office conversion to real estate happening. There's a lot less new offices being built. So in terms of the risk that higher interest rate cause, I think if we can get down, I like Dylan's idea of a much faster cutting of interest rates, but it worries me that it might panic the markets just because that sounds like recession to me. Getting down to 3% relatively quickly, I think would help with the mortgage market, help with the commercial real estate refinancing, and sort of help with companies that are exposed to interest rates a little bit better.
Interest rates to the other big I, inflation. Gareth, can you talk a little bit about, in a high inflation environment, what strategies should businesses use to protect margins and retain customers and just overall, function in such an environment?
Yeah, so that's a tough one for businesses, right? You have the costs going up and trying to pass those along to the consumer, unbelievably hard, especially when every other cost that they're experiencing is going on. For me as a business owner, I think the keys are customer service. You have to bring the value in other ways where it justifies you increasing your price to mitigate the loss in essentially profits and margins. And so that's what I would say. I think that's really important. And just going back to interest rates and inflation, I'm kind of on that same page of inflation is probably going to continue to come down a little bit more, but I do worry that the Fed aggressively cutting rates not only will start to have it uptick a little bit, but it also will scare the markets. And we saw, for the longest time, the markets would rally on any weak data because it meant the Fed could be lenient because everyone thought that we would have this soft landing. Even Jerome Powell had said soft landing, no landing at all type thing. But I think we're starting to see that consumer beginning to hurt. And just to talk about margins for businesses out there, one of the most striking trends that I'm seeing, we have a consumer that is still spending relatively well, but it's the mid to high end consumer. We had McDonald's coming out and saying that people that make under $50,000, they can't even afford to go to McDonald's anymore. Dollar Tree, Dollar General, they're getting crushed. People are being priced out of those, going to those type of places, possibly heading over to Walmart, but still, versus people that have investable income, they've done very well because the stock market's done well. And my big concern is that if the stock market starts to top out, and let's say we don't see new all-time highs, even if we don't have a big correction of 20, 30%, but if the market just kind of goes sideways for a year or two, does that then cause these consumers that have been able to spend because they've seen their 401k spiking, does that then make them pull back and cause us to flop into that recession more quickly?
Flip back to Dylan, because I do know that inflation is a sweet spot for him, and I'm curious how you would counsel businesses on how to tackle a high inflation environment.
Yeah, well, I mean, I think a lot of lessons have been learned about how to tackle these types of high inflation environments over the past couple of years. Really, though, what we've been seeing up until quite recently is, businesses definitely took a bit of a hit when inflation initially started spiking, and not everyone was able to rapidly readjust prices as high as costs were being pushed up in that era where supply chains were a real problem at the same time that demand was very high. But what we've seen over the past year or so, and this has actually been one of the overlooked forces that's been holding inflation up, maybe not so much overlooked with what some of the presidential candidates have been saying, but margins have actually been very high lately. And that's, again, just part of this sort of lagged response in terms of, costs have come down for businesses, but prices have sort of stayed roughly where they are. And now what we're seeing is competitive dynamics really starting to push down on prices at the top end, and so margins are starting to be squeezed. And we're seeing that, as Gareth said, places like McDonald's who have actively said price wars on in fast food. That's where we need to go to compete, right? So I think there's a few different places that businesses will have to think about. But again, we see a real risk that people are fighting the wrong battle. The battle now is about a slowing consumer, especially in the sort of mid to lower tiers of the market. And so how do you ensure that in light of that, and given how sensitive people are to prices now, having learned from the past few years, how do you compete? So you can compete for market share with the top line if you're confident in your ability to kind of deliver value for consumers. But what we're really seeing too is businesses starting to aggressively manage costs. And this is an important part of our general outlook, because we've seen a period in which businesses staffed up massively after COVID-19 and have held on by and large to that staff, right? Basically scarred by how hard it was to find workers during that period, and seeing margins quite high and not seeing a reason to let go of people. That's going to accelerate now. And we're starting to see the early signs of it in the labor market. And of course, to come back to Phil's point, recessions are about change, right? So you can change from quite a high level, but if you get a period of sort of even quote unquote healthy rebalancing into a more normal labor market, it's going to be a negative force from where we were, and that is a period of recessionary conditions. It's also why we don't think it's a blow up, right? It's more of a sort of reset in the economy and in the labor market. But firms will do that more and more to protect margins, and that's going to be an important factor.
Speaking to changing consumer behaviors, how should investors and businesses adapt to these changing trends in terms of how the consumer approaches their day to day?
Yeah, I mean, I think the unemployment data so far is actually not as bad as it looks. So we've obviously the unemployment rate's going up, but it looks like it's because people are coming into the workforce, because actually real wages have been increasing, and there's a lot of immigrants looking for work. So the unemployment rate at the moment is actually kind of not as bad as it would normally look if it was increasing this quickly. to Dylan's point, the layoffs haven't started to happen yet. So I think from a consumer perspective, when you see layoffs, the psychological impact of seeing your neighbor lose their job makes you stop spending, and you can get a bit of a feedback loop. I think that speaks to the SARM rule that a lot of people talk about, where when unemployment goes up as quickly as it just has, so 0.5% a year, you do tend to see a recession. The reason people are saying this time it's a bit different is because we haven't seen the layoffs. People coming into the workforce, when they get a job, they start spending. So I think the labor market is actually more back to normal than it is weakening to the point of triggering a recession. Talking to companies like a year ago, to Dylan's point, they couldn't hire people fast enough. People were leaving for higher salaries. There was workers getting paid more than their managers because that's the only way they could get people onto the books. And so it was actually really difficult for companies to staff up, especially in the services sector. It almost seems like post-COVID, everyone was buying goods, and so the manufacturing sector saw the demand first and rehired everybody. And then when the services sector, sort of when vaccines came through and we started to go back to watching sport events and going on vacation and doing all those services, the services companies couldn't staff up enough. And I think hospitality and hospitals are both still struggling to restock on the staffing side. They've seen quite high wage growth. And they're still, I think, hiring really strongly. But I mean, exactly what Dylan said, nobody has let go of people yet. Even the manufacturing sector, which if you look at PMIs, has been in recession for over a year, has hardly let anybody go. So from a consumer spending perspective, it really comes down, I think, to how much money people have left. So all the COVID stimuluses, that was years ago. It looks like, at least for people that are on lower incomes, they've spent that. It speaks to what Gareth's talking about, where people are now looking at their budget and they're looking at Walmart instead of name brands. But when you also look at the wages, we saw real wage growth, and I think that's helping. And also speaking to what Gareth talked about, with anyone that's got savings, earning 5.5% when inflation's still at 2.5, 3, you're actually starting to accumulate real interest income, which is relatively unusual in the last 20 years. So a lot of people have actually still got positive income growth, as well as the fact that I think it was Gareth talked earlier about the fact that household balance sheets are quite strong because house prices have gone up as well. So I think the consumer at the moment that's under stress, to Dylan's point, is the low-income consumer that hasn't got enough income to pay for like the food inflation and the things that all the needs that they have to buy. And so they are apparently, if you look at the credit card usage data, they're using credit cards again. They're starting to become delinquent on credit cards again. Definitely low-income people are becoming delinquent much more quickly than high-income people. And so it does seem to be at the moment focused on the low-income consumer not spending. But when you look at how much of the total spending low income does, it's actually not that big. So I think if you're a company in a space like Walmart or Dollar Store, you're concerned because that's your consumer base. But for a lot of other businesses, actually things aren't going so bad. So at the moment, it's a little bit isolated in certain segments of the consumer space, not necessarily market-wide.
Kind of circling back to the labor market and the shifts in the labor market over the last few years, including you touched on it earlier, remote work, automation. Gareth, can you speak to how these labor market shifts are impacting businesses and investment decisions?
Yeah. So I agree with a lot of what these gentlemen have said about the trends in business, right? In terms of people hiring because they couldn't. I mean, they literally do not want to let people go right now. But I do think honestly that is going to start to change. I think you're starting to see this, and we saw this with some of the data recently, like job openings. The JOLTS number starting to come down dramatically, right? So that's not people getting fired. That's just how many businesses are looking to hire new employees, and that's starting to fall. We saw some of the other numbers starting to kind of come down. You're just not seeing the firing begin yet. And that's normal for a cycle, a business cycle. It always starts that way, right? The businesses get a little nervous. They're like, all right, is this going to change and get better? Oh, wait, it's not. Now I have to start laying off employees. And so I do worry about even the high-end consumer down the line. It's just not yet. And this is just one of those slow rolling snowballs down the hill that I worry about, that in the near term, we have the kind of the patch or the Band-Aid of the fiscal stimulus, the Federal Reserve now starting to lower rates next week, most likely, kind of saying, everyone's saying, okay, things will get better, but what happens if we don't see it get better? And that's where I think it could go. So I think, again, lots of business trends will be more towards that layoff and kind of a tighter budget. The COVID money, we got, the government was sending these checks out to people. There was so much money. It created like the meme stock craze. You could the crypto craze in many ways, the Doge coins. I mean, people were just getting checks in the mail while sitting at home. That money now seems to be running out. We see the savings rate coming down. And so again, the consumer's beginning to hurt a little bit more. I think the high end is still okay. But I am concerned about the next 6 to 12 months. And I think businesses have to be ready for that. And again, I think even with the delinquency rates I mentioned earlier, these are little breadcrumbs that are showing that things are kind of changing. They're just not at that break point yet.
Dylan, your thoughts here in terms of the shifting labor market? I know it's an area that you pay close attention to.
Yeah, look, I mean, I think we see very consistent patterns every time the labor market weakens, right? And it's just a lot to do with human nature, right? When firms realize that they have, their wage bills are too high relative to where they're seeing the economy and where they're seeing the consumer and their sales, the first move is not to fire as many people as you can. It's to trim hours a little bit. It's to move people from full-time contracts to part-time contracts. And that we've been seeing for several months already ongoing. Now, those trends are a reliable indicator that the labor market is loosening. And we're just now starting to see that translating into full-on firings, right? I mean, I think one thing I'd point out, at the risk of getting a little bit nerdy, but one of the best papers at the Jackson Hole conference that we saw this year, and one actually that Chairman Powell referenced a lot in his speech, was one that basically said, look, we have almost a new way to understand the labor market from the size of the shock that we had around the pandemic, which is that the first thing you see in terms of a labor market rebalancing is vacancy rates going down. So firms just stop posting job ads at the rate that they were, but they hold onto their labor. And that is actually basically, has no sort of effect on inflation and wages, because it signals that the labor market's still very, very tight. Then what you get is a kind of kink as firms, sort of run through that part of the process and start moving towards, actively not only not hiring, but actively letting go of people, right? And so we're going to see the unemployment rate move up and up and up as the labor force grows. And on the other side of it, as we get flows from employed to part-time and part-time to unemployed.
A little bit from consumer behavior and the labor market. Daniel, can you speak to what trends you're seeing emerging from recent shifts in global trade and the impact that you expect that those shifts to happen in the next 12 months or so?
Yes, I think that what we are seeing is that trade growth continues to happen, but at a much slower pace. And it's also important to look at it in real terms, because a lot of the data comes in nominal terms, and I don't care about that. No, so and when I say real terms, is because a lot of the real exports from many countries are actually pretty disguised by, let's say, more than creative way of using deflators. So in general, the trend is of continued growth. However, it's a slowdown. It's a significant slowdown. And this is something that we have seen in previous occasions in which the level of inflation is so high and the level of money creation is so steep in very little time that when it starts to slow down, it gives the impression that virtually nothing is happening, no? And the false illusion of the so-called soft landing, no? There's no such thing as a soft landing. Either you have stagflation or you have a recession. It's much more likely that what we will see is that now the trends of disinflation are starting to stop, no? And not just stop, but in fact, money growth is coming back, no? And if rate cuts start to happen at the pace at which central banks, or at least consensus, is expecting, between 2 to 4 times for this year, that is certainly likely to inflate a little bit the challenge. So I think that for businesses and for anybody, what we need to be is aware that the level of global trade is shifting to countries that are more focused on added value products and technology, and less on the historical exporting countries like the emerging economies, etc. We are seeing very, very weak figures from the traditional exporters, in developed and in emerging economies. I would therefore be very, very cautious, or at least prudent, from the perspective of thinking that there's going to be a significant bounce in global trade, and that will ease the cost inflation for businesses. No?
Gareth, you touched on this earlier. What are your thoughts in terms of global trade trends and the impact you might see for investors? You mentioned before different, economies and different investment opportunities and different areas that you maybe perhaps weren't looking at. I would love to get your perspective.
Yeah, absolutely. So I think one of the most intriguing things that's occurred since COVID is what's happened to China, right? So China went through the beginnings of COVID and went through it, and it didn't see the same bounce that the consumer spending in the U.S. got, right? So we had this great surge in economic activity while China was mired in basically a slump that has lasted since COVID, and they still are. I think part of that was the Chinese cracking down on not only their own companies, but also international companies that were coming over there. And that really put a damper on the recovery, because what it did was it made a lot of businesses that were opening plants and doing manufacturing in China say, wait, we can't have all our eggs in one basket over here. We need to rotate into places like India, Thailand, and other countries. And so you really saw this exodus there, or at least less growth from the international community in China, which has, again, mired them in this kind of long-lasting recession. Granted, their real estate situation is really dire as well, because they overspent and built these, basically cities that have no one living in it. But one of the things I've noticed recently that I'm paying very close attention to is the Chinese government ended their antitrust looking into it, at least into Alibaba. To me, I just paid attention to that. And then I've noticed a few comments by the Chinese that are starting to woo back international companies and investors back towards their country. And I think there might be an opportunity there where China's starting to realize they kind of screwed up here. They went a little too hard, and now it's chased so much investment dollars away, that they have to actually play nice. And it may be an opportunity for us as investors to potentially see some big rallies in their market. Now, we haven't seen it yet, but I'm curious if we continue to see the government wooing back in investor money into the country. And I think one of the things that's catching my eye, I pay attention to what some of the big hedge fund managers do. David Tepper's heavily invested in China now. Michael Burry's heavily invested in China. So you are seeing this, and I always pride myself on trying to be, a little early. Granted, sometimes I get in too early to these trades, but I like to see these trends changing and kind of catch that full movement up versus being late to the party. So that's kind of an interesting little trend that could be adjusting, that I think investors should pay attention to.
Kind of sticking with the theme of global trade and something that was mentioned earlier, in terms of currency volatility, Dylan, what are your thoughts in terms of where opportunities might lie, or where the risk might be as businesses operate, as investors look to make investments, and as banks lend?
Yeah, well, I mean, I'll pull it back to the macro theme, because I think if you're walking with me on the idea that U.S. rates are going to fall relatively fast, and those first few rate cuts won't be enough to kind of generate the sort of stimulus that the Fed will be looking for, you're going to see quite a big squeeze in terms of interest margins between the U.S. and several key economies. And the one I'd really like to talk about a bit is Japan. Because that's where one of the biggest structural shifts kind of in the global economy has been taking place. Right? We've seen for the last 30 years on, Japan's been kind of stuck in this awful secular stagnation, and only really started fully addressing it under Prime Minister Abe and the Abenomics regime, which initially, focused on these extraordinary stimulus measures, mostly fiscal, but also a deep commitment to very, very loose monetary policy through an inflation overshoot. And that has kept interest rates in Japan very, very low. In fact, negative at the time when the rest of the world was rapidly increasing interest rates. There were also a series of demographic reforms that took place around there, real efforts to get a better gender balance in the labor force and tap the female workforce in Japan to offset some of the demographic challenges in terms of aging that the country's facing. Very quietly, a much more positive attitude towards immigration and sourcing labor from overseas. And then obviously a whole series of reforms to how Japanese corporations work, how they treat their savings, how focused they are on delivering on their mandate towards investors. And we're seeing with the Couche-Tard deal that's happening at the moment, that would never have been possible a few years ago. So, we think Japan is actually digging its way out of this period of secular stagnation and is in line for both a more inflationary period and a period of stronger growth, right? And on a cyclical time point, that means that we're going to see rates eke up in Japan. They're not going to shoot the lights out. They're going to have 5% rates in Japan, but we are going to have more like 0.5%, 1%, maybe up to 2%. And that will squeeze up the margin with the US as US rates come down. And what that really does is it completely eradicates. We've seen half of it gone already, but it really unwinds this idea of a yen carry trade where you can borrow in yen, stick your money in dollars, rinse and repeat, and basically collect free arbitrage. That becomes much less appealing, which means that a big force that's been keeping the yen undervalued goes away. And you can start looking at the yen on a more fundamentals basis in terms of what does higher Japanese growth, somewhat higher Japanese inflation, and a smaller interest margin mean for the currency? Well, it should appreciate. And we're already seeing that. It can go a lot further, we think. We have a target below 120. If you look at fundamental measures like purchasing power parity, the Big Bang Index or the more complete OECD type measures, you get it under 100, which probably is out of not quite possible for the next little while. But even if you trace halfway there, you get a very big return, and it's a pretty easy trade to implement. The other thing we just point out on Japan is that that growth and reform story. And appreciating yen is not great for Japanese multinationals who report earnings in yen, right? So they do get hurt a little bit if the yen appreciates steadily for several years. But the domestic growth story is looking very strong. We have a lot of investors piling in, not just to Japanese listed equities, but private equity is really looking at Japan as a source of sustainable growth and returns. And that tells you that anything exposed to Japanese domestic growth is probably a pretty good bet. So we would look to the smaller stocks in Japan, the kind of indices of the small and medium businesses, as well as the banks who are set to benefit from this environment.
What is your take on the opportunity that exists with currency volatility in the global economy?
So is that directed?
Yeah.
Yeah. It's kind of interesting actually listening to Dylan and Gareth. They both mentioned the word demographics. And if you look at, obviously China also has a declining birth rate, and it's expecting its population to almost halve in the next 50 or 60 years. When you look at Japan, its population started to shrink in the 90s, and that's when its interest rates went to basically zero, and that wasn't enough to stimulate its economy. When you think about what happened in Europe, its population started to shrink in sort of 2012, 2013. That's when Europe put interest rates negative, and it still wasn't really enough to stimulate its economy. Dylan was talking about how low rates could go. Maybe talking about what normal rates are is a more interesting question, because the Fed's saying 3% is normal. But actually with the US population, it's pretty close to zero population growth. Our birth rate is actually below 2. So our domestic growth is negative. It's immigration that's keeping the US economy and the US population growing. But the sort of natural demand that comes through from having no population growth is much weaker than we would have seen in the 70s, which people are worried about inflation respiking like the 70s, or the 90s, which was last time we really saw positive real interest rates. It's kind of an interesting thing. You could see interest rates get quite a lot lower than we might all be talking about, just because the population growth in the developed world is really going to be quite weak going forward. And there's just not enough demand to really hold things up. So obviously that affects currencies because, to Dylan's point, there's a relative value trade. The US interest rates are currently really quite high in developed market terms, but so is the US GDP growth. And maybe that's all because of the AI trade and what's happening in the stock market. If we think forward 3 or 4 years, the demographics are definitely a sort of headwind against almost all of the developed countries. We could actually see the R star, or the sort of non-expansionary interest rate, being quite a lot lower. If the guys are right about the deflationary impacts of trade and labor, and I'm right about the demographics being a bit of a headwind as well, we could see relatively low interest rates around the world, which obviously changes a lot of the relative currency dynamics that we've seen just lately. A flip side of that, though, is I think it was Gareth was talking about who's going to buy the government debt and how we're going to finance all these deficits. And if we have really low interest rates, then we see what happened in Japan. They have much higher debt to GDP than us, because, to Dylan's point, they've been spending fiscally to try and keep their economy from stalling. We could afford all the debt that we've actually accumulated just because interest rates can be lower, because the demographics just doesn't push them up.
What are your thoughts? Daniel.
I'm going to disagree in a few things, although I agree with the demographic element is very high. But I think that what we are missing at the end is that the problem that we're seeing globally is that the amount of fiscal stimulus implemented generates lower and lower multiplier effects to the extent of generating zero multiplier effects and higher levels of debt. Therefore, it is very, very difficult for any economy that has entered into secular stagnation to come back to strong growth, because the level of unfunded liabilities in the system is so huge that it doesn't even matter what the deficit of 1 year is. In the case of the euro area, the unfunded liabilities are about 300% of GDP. In the case of the United States, is a little bit less, but not particularly sympathetic to growth, which is about 150% of GDP. In Japan, it's not even worth talking about it because it exceeds 500% of GDP. Therefore, it's not just the amount of debt accumulated right now, but what is coming. What this suggests to me is, and I may disagree with a couple of the points, is that what we are seeing actually is not a de-dollarization. We're going to see a massive re-dollarization of the world that we are already seeing in any case. And that the fiat world is impossible to be maintained in the current environment, because it's not just what is the fiscal deficit of 2024, is the fiscal deficit of 2034. In the case of the United States, in the Treasury's own estimates, it's 16 trillion of new debt between 2024 and 2034. Even if interest rates fall to the pre-pandemic level, that means that the United States, like Japan, is going to spend between 15 to 20% of its budget only on interest expenses, even if interest rates are low. In the case of Japan now, it's 25%. So that is only going to generate either a persistent inflation environment in which fiat currencies continue to depreciate relative to the dollar, while the dollar loses purchasing power and continues to lose purchasing power, or a fiscal crisis. I don't think that there will be a fiscal crisis, because central banks will always err on the side of governments. No? If we get to the next stage of monetary destruction that we are right now, what we are very likely to see is that the number of currencies in the world that are not money, which currently stands at more than 50% of them, i.e., they're not reserve of value, they're not unit of exchange, and they're not medium unit of measure. The number of them that will not be money in the next in the next decade is probably going to be the vast majority of them, and only a handful of currencies that remain acceptable from a global perspective and in the financial world. So that makes it very, very difficult for fiat currencies to strengthen relative to the US dollar, and for the US dollar to stop losing purchasing power. Remember that this year, in the 72 elections that we have measured, none of the parties that have presented themselves to the elections have discussed how to balance the budget. Zero.
Thank you, Daniel, for your perspective. While we're talking, I'd like to shift the conversation just slightly to renewable energy and the impact on economic growth and where investment opportunities might lie or where there might be risks. What are your thoughts on renewable energy and its impact on opportunities and frankly, the related risks?
Me?
Yes.
Okay. We're very bullish on renewable energy from a private equity perspective, exceedingly cautious, if not negative, on a quoted equity perspective. The difference between one and the other is how markets are valuing the existing growth and how companies are managing their balance sheet. It's not a question of the technology, it is a question of the balance sheet. So I think that renewable energy has a tremendous level of growth ahead. We're particularly positive on wind and on solar, in photovoltaic solar. And there's a massive mineral constraint in general for the renewable sector. The renewable sector requires a significant amount of copper mining, a monster multiplying increase in mining of copper, of lithium, of everything that has to do with rare earths, etc. The electric vehicle trend certainly has a resource limit, apart from a monetary and a fiscal limit and an economic limit. So we're very bullish, but we don't want to get carried away with multiples. The problem is multiple expansion based on way too optimistic assumptions. So very positive on the private equity side. A lot of projects that are generating very, very good returns, particularly even if we have a disinflationary environment like the one that Dylan was mentioning. But if you have an inflationary one or a stagflationary one as well, and I am hugely negative on oil and on fossil fuels in general, not just from the perspective of the improvement or the growth in renewables, but from the reality of how the landscape is changing, considering both the environment for demand for the industry, as well as the shift of who produces the largest amount. The United States now produces about 40% more than Saudi Arabia. So it's a completely different landscape of pricing.
Gareth, I would be curious your thoughts on renewable energy and the investment opportunities that lie there.
Yeah, so I agree with a lot of what Daniel said. I think oil, for me, on a technical basis, looking at the chart, we broke down below about $73, $72, and the next support's around 63 to 64. You look at charts of oil coming down and breaking key supports, potentially a $40 handle next year at some point I could see. And again, you have to think about where the economy is if it gets to those levels. So I would remain bearish on oil overall. Now, renewables, I agree. I think the tricky thing is, as an investor, is something like First Solar investable at the current PE ratio that it's trading at, or do you have to go into to find more specialized, new projects that are in the private market, like Daniel mentioned. And I think that's a good question. We have seen a lot of these come back down. SunPower filed for bankruptcy recently, so there is this flushing out of the weak hands in the sector. But I remain really bullish on renewables overall as well. And I think, again, looking for these projects, I've been seeing, various companies coming out with batteries for EVs that can do, 600-700 miles, even 800 or 900 miles on a single charge. And I think that's where this is going to go. And I also think that, we are overlooking at least somewhat the market, the robo-taxi angle. I think most of the robo-taxis are going to be electric vehicles. They're not going to be gas vehicles. And there's a lot of potential investments there. I'm not a huge fan of the Tesla premium, to be honest. I think it's a little bit expensive, but I think there are other ways to play in that supply chain where you can get involved. So I think very, very positive on renewables.
Your perspective on renewables and the investment opportunities in the market and the conversations you're having. Phil?
Sorry, I missed my name again. It's a super interesting space. There in Europe, there's quite a lot of investor interest to invest in ESG space. Less so here, and one of the biggest problems I think is there's not really good reporting and data collection to work out which companies are really going to contribute to the transition to green energy. But when you look at some of the obvious plays, like Gareth talked about, the costs of doing solar and wind are coming down. They're kind of getting competitive now with oil and energy and other sort of older energy. But obviously, the infrastructure cost to build out the manufacturing of all those facilities is so high that a lot of the equities, or there's ETFs that you can invest in now that invest in all of these kinds of solar and wind technologies companies, aren't actually performing that well. So it looks like the capital costs are still pretty high, and the amortization is making it hard to be profitable, even though the variable costs of the actual energy on the sort of renewable front is pretty competitive with old energy. So far, it's been really tricky to do the obvious trades, which is to buy solar and to buy those kind of energy products. I think longer term, maybe what the investors need to look at is how insurance companies are dealing with things like the risks. So, with weather and fire and flooding becoming more costly, that's going to fall on insurance companies. And so their margins are going to be sort of crimped unless they can work out how to tackle, insuring people, but also not running at a loss when you have these big events. So I think the green energy space and the environmental sort of ESG complex is still being worked out. It's really difficult to know how to play that. It's probably a 10-year trade. And it's, we kind of need to get the infrastructure in place so that there are viable companies with good revenue streams and they've paid off or amortized all of their fixed investments.
Perfect segue to where I was going to take the conversation next. We're kind of coming up to the tail end of our time together, and we've spent a lot of time talking about current trends, coming trends, 12 to 18 months. I'm curious, Phil, from your perspective, what long-term global shifts do you foresee in the next 5 to 10 years? And how would you be counseling companies and businesses to prepare?
Yeah, I worry a lot about the demographics that I talked about because most of the developed countries are seeing their populations shrink, seeing their workforces age. And so that's really going to be a big shift in terms of consumer spending, what consumers want to buy, which companies are going to be in good positions. I would think hospitality and healthcare, at some point, they're going to have a lot of demand. Maybe the costs don't make it profitable, but there's going to be a lot of older people that need nurses and need medical care and need operations and things like that. So I can see a shift in terms of what the spending patterns of consumers are. But at the same time, I think from an economic growth perspective, it's going to be really challenging because we don't have the population growth that just naturally creates, revenue growth and sales growth and new business opportunities in terms of just the existing same store sort of complex. So I think we're going to see shifts in spending behaviors. I think we're going to see a more slow economy. I know the guys earlier talked about, maybe the next 2 years is going to be relatively slow growth, but not recession. It might kind of be hard to get out of that pattern if it's not sort of coming through from the emerging market side, growing the global pool, from them investing and getting more production of their own, and sort of using their cost base to grow the global GDP pool. I think developed countries are going to be a little bit of a handbrake on global growth.
Phil, I understand my mic's being a little temperamental, so I apologize for that. Dylan, what, from your perspective, thinking long-term, next 5 to 10 years, what global shifts do you foresee?
Well, Phil's covered demographics. I think what's absolutely fascinating on this call is that every single one of us, I think, has expressed concern about the high level of US debt and the prospect that deficits will probably continue to grow. At least if you take both candidates on face value, the best case scenario is a flat to rising deficit ratio to share of GDP. Meanwhile, interest costs are going up and up and up, right? So if Japan's taught us anything, it's probably that these types of trends can take a long time before they reach crisis mode, and it's very difficult to get any action in place until you're at some kind of until you feel a lot of pressure to do that politically. I think that's what's playing out now. But I think over the next 5 to 10 years, that's a sort of reasonable period to expect everyone to get worried enough about it that some real pressure comes to bear. And so I'll make a little prediction here to leave you with, which is that the next US election, 2028, is going to be dominated by discussions about the national debt, just as it was in 1990, after, by the way, a very large inflation spike in the 80s. And so, that's the thing that I'm most worried about. And I'm worried about the effect that rising fiscal burden starts to have on growth and productivity. At the moment, it's boosting growth, but it won't do that forever because it's going to start detracting from growth when interest costs just get too high, when productive investments get shifted away from government and the private sector gets crowded out, et cetera, et cetera. And so that's something that we should all be focused on. But, I'll leave you with a positive case. I think there is a lot that can be done about it. And I think the US is crying out for some real structural reforms. Hopefully this creates the impetus for some of those reforms to start to happen. But we'll see what Congress looks like and how likely that is in the next 4 years.
So as we come down to the final few minutes together, I would love to go around the table, have each of you kind of comment, given the dynamic and interconnected nature of these global trends and threats. What is the single most important piece of advice that you would offer to investors, businesses, companies navigating the challenges and opportunities in the coming years? Start with Gareth. I'm just going around my screen. One piece of advice that you would offer those trying to navigate these global trends.
Yeah. So first of all, thank you for having us and me. It's actually been very enlightening. Great to hear these people, everyone on the panel speak. So thank you guys. For me, I'm going to take it from a different angle. This is something I deal with a lot of retail, a lot of people on social media, younger people that are getting into investing. And the biggest issue that I see in terms of a change from when I started investing back in 99, 2000 to current is that there's so much more emotion and polarization in the investment world, right? You're either on this side or on that side. People are on social media going crazy and pumping from influencers, investments in crypto. And for me, learning the hard way in my early career, it was all about, getting caught up in these narratives and then jumping on board, but I'm jumping on too late and then I take a loss. And so my advice would be to investors that follow the data. The data doesn't lie. It is what it is. A chart is a chart. It doesn't have a narrative. It doesn't have an agenda. And by doing that, you'll make much better decisions for your overall investments going forward. And so, again, I think that's really important in this day and age where social media has taken over so much, especially for the younger generations. You have to be able to shut that out and actually go to the facts, look at the facts and make that decision off of that.
Gareth. Phil. What single piece of advice would you offer to the audience?
Yeah, I mean, I love where Gareth's going with this because obviously I work at Nasdaq, so I care about companies and investing, and you see actually companies have outperformed, like the markets have outperformed even housing as an investment. So I think it's great that we've had retail investors coming into the stock market. I know the guys talked about how they've increased their wealth because of how well things have gone, all the stimulus, and how there's a little bit of a risk if they start to see some losses if we have a sell-off. So I think diversification is really important. I think owning it, we've talked about healthcare, we've talked about energy, we've talked about different countries, but at the end of the day, one of us might be right, but it's really difficult to know who and what's going to play out and whether the companies will benefit from it. So diversification is really important. And the other thing, sort of speaking to Gareth's point, focused on data, if you look at stock prices, most of the returns at the end of the day are driven by earnings growth. So I know I talked at the very start about how the outperformance of the US market is a lot of the AI trend, but it's real earnings growth in those companies that are selling chips and selling cloud. If that changes and small caps start to have more profitability because rates come down, or healthcare starts to have more profitability because people are getting older, you will see those sectors outperform. But know that if a stock is getting ahead of its earnings are going to have to catch up, or the stock is going to look rich eventually to investors. So actually seeing real earnings is important. It's the reason why we all use the price earnings multiple as a basic guide to whether the market is rich or cheap, because over time, earnings and prices stay in track really well.
We're down to the last couple of minutes, so if you could give your piece of advice, and then we'll wrap up with Daniel. We started with him, and we'll end with him. So, Dylan.
Well, I think I hope I'm not wrong here, but I think I'm the only millennial on the call. So very much appreciating all the investment advice from my very learned colleagues. I'll add one more to that, which I think is in the same theme, which is please diversify your portfolios. All sorts of data coming out of the last year, or really post-COVID period, that people are almost exclusively sitting in stocks and almost exclusively sitting in those very big name stocks that have been delivering outsized performance. Now, that's fine. People have been riding the wave, but valuations are looking stretched, and you don't want to be on the other side of that price move, right? Meanwhile, people are underinvested in bonds enormously at a time when bonds are both yielding well still and about to see a whole lot of price appreciation as the Fed starts to cut. People are not backing up a share of the portfolio with hard assets. And so, that's what I would encourage everyone to think quite hard about. We've spoken a lot about the different potential outlooks, the different potential moves that we're going to see in the economy. The best way to deal with that is to take advantage of the magic of diversification.
Dylan and Daniel, if you can round us out.
Apart from everything that has been said, which is absolute logic and perfect, I would say to anyone that's looking, don't expect governments to make you money. It's going to be impossible. The level of monetary destruction we are going to see in the next 10 years is going to be unparalleled compared with the one that we have seen so far. So every time that you see a correction, don't get nervous. Look for opportunities for the long term. And in the long term, we have talked about demographics, we have talked about the sustainability and renewable energies, and we have talked about disruptive technologies. Those are long-term trends to look. And obviously, if for monetary destruction, don't try to find the solution in sovereign debt, because governments are not going to give you free money. They will not.
Thank you, everyone. Thank you very much to our panel for joining and providing such great insight. I know I learned a lot and very much enjoyed the discussion. I believe I'm passing the baton over to David at this point.
Thank you very much. It's been a pleasure.
Good morning, everyone. I'm Seth Dennison, Managing Director of Investor Relations here at OptimumBank. And that was an incredible first panel. Very much appreciate everybody's participation in the first panel. And now the second one is going to be of equal stature. Second panel is titled Inflation's Impact, Aligning Monetary Policy with Banking Investment Strategies. Today, we have the privilege of hearing from a distinguished group of experts will provide invaluable insights into how inflation is influencing both monetary policy and investment strategies. Our esteemed panelists include Jim Bianco, a highly regarded market analyst known for his deep understanding of macroeconomic trends, Rebel Cole, a professor and expert in banking and financial markets, who brings extensive academic and practical experience, Tavi Costa, a respected portfolio manager and market strategist, recognized for his unique perspectives on macroeconomic themes, and Nathan Stovall, a leading expert in banking research who offers keen insights into the intersection of policy and banking. Moderating today's discussion is Albert Dotson Jr., whose expertise in law and finance will guide our conversation. Please join me in welcoming this exceptional panel as they explore the critical connections between inflation, monetary policy, and investment strategies.
Albert, I think you're muted.
All right, so we're like 4 years past the pandemic, and muting and unmuting is supposed to be something that we do intuitively. And thank you, Nathan, for noticing my lips moving and no sound coming out. If you were listening to the prior panel, the conversation was absolutely amazing. And they touched on some of the topics we're going to touch on today, but I want to join my prior moderator in thanking Florida Atlantic University and OptimumBank for pulling you all together and hosting this conversation. So what I'm going to do, I'm going to start talking about inflation forecasts, economic indicators, and employment indicators first. We'll give each of you an opportunity to share your thoughts on the first few questions, and then we'll come back and have some specific questions directed at you individually. So first, on inflation forecasts, what are the key indicators that you are focused on to suggest where inflation is heading over the next 12 to 18 months? I'm going to start with you, Jim.
Thanks, Albert, for having me, and thanks for having me on the panel. Let me just say off the top, when it comes to inflation, I am of the opinion that we hit a cyclical low in inflation in 2020. Coming out of the pandemic, we're going to have persistently higher inflation. We'll develop those theories out a little bit later. But to your question about the indicators that I'm looking at largely at wages and a lot of wage measures that we see. I do think that what we're seeing in this economy is that the shift is moving from management towards labor. Labor has a lot more power to demand higher wages, and we're seeing that along the way. The other thing I've been looking at on the good side has been shipping costs, shipping delays, and any kind of measure of, say, bottlenecks, because that seems to be the biggest driver right now of goods inflation. And unfortunately, we're starting to see more of those bottlenecks starting to appear. Not as bad as we saw in 22 when we had all those ships off the port of Los Angeles stocked up waiting to unload. But it's definitely not something that we would refer to as normal. So labor and basically shipping costs would probably be the two that I would start off with highlighting.
Dr. Cole? See, there's someone else muted. I love it. It's not just me.
Me too, yeah. I'm looking at oil prices. Oil prices are currently below $70, which is very bullish right now. But with the current situation in the Middle East, in Gaza and in Iran, in Yemen, we could easily see oil prices spike back up to $100, which would be very inflationary as we saw back in the 70s. I'm also looking at the labor markets, looking at employment for clues to what's going to happen to wages. As Jim said, wage inflation is one of the primary things we're going to be looking at. So those are probably the two major things I'm keeping my eye out on, as well as commodity prices in general.
Got it. Tavi?
I think The difficulty of having, of sharing your thoughts as one of the last ones is that most of the folks that are smart here already shared some very important indicators. So I'm going to try to share something that I think it's important as well, but it hasn't been shared. I am paying very close attention to the US dollar. It's remarkable that in 2021, when inflation was surging, the dollar was actually strengthening as well. I am very concerned about the US dollar. To me, reminds me when I looked at the 1919 Spanish flu and started to have very high conviction on inflation. And then it started to look at the treasury issuances and had a very high conviction on yields moving higher. I'm not here to say I got everything right. I definitely didn't. But this reminds me a lot of that. There's a lot of signs to me that the dollar weakness is likely ahead of us. And the reason why that matters is particularly when you're running a twin deficit. And I'm referring to, yes, it's normal to run a twin deficit if you are the reserve currency, but it's not normal to run a double digit one. And we're now, to Jim's point regarding freight costs and imports are actually starting to become a problem as well. And so I would add that to the inflation camp. I think that's likely to become more and more a problem. And as the Fed is in my view, I love the obsession on labor markets and inflation, but in my view, the real problem here is at the end of the day, for the next 12 months, maybe 2 years or so, will be the interest payment issue. And I just don't see a route out of significantly rate cuts relative to other places in the world, which should have an impact on the dollar. That's my main concern, on top of the twin deficit. And so I would think that that's going to add to the inflationary trend. Commodities obviously will play a role there. Somebody talked about the crude, and you look at the long positions on crude today, or I should say in WTI, one of the lowest we've seen in a very long time, over a decade. So clearly that's a contrarian view. Not a lot of people expect inflation to really come back, to resurgence of inflation being a real issue. And I'm very concerned about that.
Thanks. So Nathan, Tavi says that everything's already been shared with those who are viewing, but I suspect you have some thoughts about that question.
Well, I certainly agree with everything that was said. And as Jim said, we spend a lot of time looking at the labor market and the consumer in particular, we're a consumer driven economy, and looking at things like wages and, can they keep up in the face of inflation? And thus far, we have seen that slightly exceed, as we heard in the last panel. One of the things I'm just looking at is spending and what is actually driving that. The consumer was really held up in no small part through a lot of stimulus through the pandemic. They accumulated nearly 2 trillion excess savings, but those have been exhausted. And a lot of the spending is really held up due to cards, growth in cards. And our savings rates have come down considerably. It's not to say the consumer isn't saving, but we're effectively borrowing a lot to prop up that spending. It's not to a place that I'm really, really that worried. One of the things, while car growth gets so much attention, one of the reasons the consumer hasn't really run out of gas is that they did what corporates did, an extended duration when rates were low. Our biggest debt service component is our mortgage, and everybody refied in 20 and 21. So while you've seen those other components go up, you've actually seen household debt to income not go to worrying levels. We're about 1.5% below the 40-year average. And so I want to see, is the consumer going to run out of gas? Two other little small components when you look at what has really driven up the inflation numbers. Shelter has been pretty darn sticky. I mentioned the household component in terms of homeowners, but on the renting side, we don't see a lot of relief there. Still not enough supply on the homes, on the housing side. So we don't know how much that actually comes down. And one little tiny one is car insurance, where rates have been really, really high. And one good news there for consumers, it's sort of bad news in the short term. Auto insurance, they have not made money. Auto insurers have not for the last few years. We do think that they will regain profitability this year, which means they won't be able to push as many rate increases going forward. So you could see some easing after near-term pain there.
Yeah, I guess for those of us who are paying car insurance, we know that the profitability had better go up because the rates definitely did. So I'm gonna go back to Jim and Tavi. Both of you mentioned imports and shipping and bottlenecks, and made the reference, Jim, to won't be as bad as 2022. Can you just delve a little bit more into what you're seeing in connection with shipping and bottlenecks, both of you? I'll start with you, Tavi, this time, so he's not last. I don't want to repeat the same error before, and then I'll
No,
go back to you, Jim.
it's not an error. There's no way around it, and there's only a lot of smart guys here, so everybody will share very good insights. I think that the trend that is important, and looking a little bit more longer term, goes back to the deglobalization trends we're seeing, and that's that will be something that will continue to add to the inflation front in a big way. These disruptions in logistics, the Red Sea is one example, but I just don't think that would, a lot of people tend to see these issues very unique in a very unique fashion. And I think they're all interconnected. When you think about inflation and imports of things, commodities to me is a reason why I spend so much time on natural resources in terms of research and deploying capital is because they tend to sort of have these long-term cycles that is really predicated on the capital spending of companies in general. And so, we've had the overspending over the last decade or so, and now we're on the other side of that. So while we may pinpoint into potential triggers that can create logistics and other issues, at the end of the day, in my view, that's the big theme is the lack of spending in natural resources, and the fact that we're seeing the other side of that globalization trend actually reversing will continue to add to the inflation front in a large way. So to me, it's the reason why if we see further rate cuts and further depreciation of the dollar on top of what we have currently, it's not a doom and gloom. I think there's lots of opportunities that come from an environment like this. And it's just that the leadership of the market, in my view, it's not fully, I guess, reflecting some of those changes. And those changes take time to reflect in markets as well. And so we've had some of those parts of leadership change in the last 2 to 3 years. Emerging markets did all right, despite the fact that we had one of the longest hiking cycles in a very long time. And so you're starting to see some of these trends unleash. And they're all together. It's commodities, it's emerging markets, it's the weakness of the dollar, it's gold doing very well. So, I would not fade any of these trends. I think they're here to stay, and inflation will probably be, just stronger than historical standards, going back to the deglobalization trends that likely to continue, in my view.
Thank you. And Jim?
Yeah, I'll take it from the production to the transportation side. On the production side, we're going to talk about goods here mainly. Remember, just to put this in perspective, about 25 to 30%, depending on the measure you look at, of the average budget in the United States is goods. The rest of it is usually services. So we're talking about a minority of what people spend their money on. The majority is on services. On the production side, a lot of those goods come from our trading partners, and the one that everybody focuses on is China. And two things are happening with China right now. One, there is a deglobalization wave going on where everybody is trying to friendshore, which means we're trying to move our production to places that are friendlier or don't have as much political friction as China does. Highlighting that is Apple in their move to try and make the iPhones now in India, as opposed to making them in China. And they're actually finding it to be extraordinarily difficult to try and do. It's easy to say, it's very difficult to do. And then if you throw on top of that, if you take a look at what's happening with the Chinese economy, it's in a world of hurt. There's just no way to put it around it. The Chinese economy is growing at about its worst levels in the last 40 years, other than maybe the COVID lockdown in Tiananmen Square. This is about as bad as it gets right now. The Chinese stock market is falling. And this is a stock market, I might add, that they have rules that they will jail speculators or brokerage firms that write negative research reports. They will go to jail, and yet their stock market's still going down. And interest rates in China are at all-time lows. So you've got the production side of it, turmoil because of deglobalization, and you've got the Chinese, which is kind of the factory of the world, not in a good place economically. Then you put that stuff on a ship and you start sending it around the world. I do track the IMF port call data, and in the IMF port call data, a port call is how many times a ship comes to port. That is down about a third this year worldwide. In other words, because of problems in the Red Sea and container shippings have to go around the Cape of Good Hope, because of low level water levels in the Panama Canal, which has recently been rising, but yet shipping hasn't returned to normal, it is significantly taking more time to ship something from Asia to the United States or from Asia to Europe. Whereas a typical container ship might do 6 runs a year between, say, Asia and Europe, just go back and forth with containers. They can only do 4.5 or so. And so all of a sudden, what that suggests right there is you've lost about a third of your shipping capacity because those ships are taking longer. You can't turn them around. That has driven up shipping costs quite a bit. They're up almost double from where they were in January. Now, that gets spread upon everything that's in those containers, but you've just doubled those costs. And in a world where we're worried about whether or not the inflation rate is 2% or 2.3% or 2.4%, when you double the shipping costs and when you have problems at your production end, because either you're trying to move to a friendlier country or the country you're working in China is having a lot of economic trouble, these things can add up real quickly. They can create a lot of goods inflation, a lot of goods problems.
Well, Jim, I'm glad you're not sharing any negative reports in China, because we would not want to have you jailed as a result of that. But I do want to.
That's why I'm saying it from the United States.
That's exactly right. So, Rebel, I want to come to you. You talked about oil prices and crude, and others did as well. Can you delve a little bit deeper into why you're focused on that as key indicators for forecasting inflation?
Oil is not muted, am I? Oil
No,
is
we can hear you clearly.
Oil is a fundamental feedstock for the production of so many things, and energy prices percolate throughout the economy. So if we see a spike up in oil prices because of unrest in the Middle East, for example, we have, Jim mentioned the Houthis just set on fire 1 billion gallons of oil in the Middle East Gulf, then that's going to have implications for the entire economy and obviously inflation as those prices percolate through the economy and show up in everything that we consume.
So Nathan, I'm going to start. I'm sorry, someone wanted to say something? No? Okay, Nathan, I'm going to start with you. I'm going to ask this question of you, and then each of you will have an opportunity to respond. But I have to say, Nathan, I wrote down your comment about consumers running out of gas. Great play on words there. That was amazing. So we're going to give you another opportunity to share your thoughts about economic indicators. Beyond traditional indicators like CPI and PPI, what alternative economic indicators should investors and banks monitor to better anticipate inflationary or deflationary trends?
Well, there's an old line that banks are thermometers of their local economies, and I look at the U.S. banking industry as a whole. So one of the things is the industry as a whole is a thermometer of the U.S. economy. And one of the measures I really look at is what does loan growth look like? Because companies and consumers borrow when they feel better, and when things get bad, they tighten up, they delever, and that can lead to an economic slowdown. So one of the things we're spending a lot of time on, and we always do, is what is happening to actually loan growth. And it's been weak. It's been weak, and it's been really weak for 2 reasons. Demand is weak, and we actually saw loans contract across the banking industry in the first quarter, rebounded some in the second quarter. I mentioned demand being weak, but some of this, and I should start here, has been driven by banks tightening standards. And one of the things you see heading into a recession is that banks tighten standards because they're worried about a downturn, and eventually they make credit less available, and it comes kind of a self-fulfilling prophecy. The good news there is that we're primarily seeing it in the commercial real estate segment. You wake up every day and you see some headline about gloom and doom around commercial real estate, and the idea that being the combination of challenged cash flows, because you've got things like return to office, challenging office properties, not everything is office, but certainly when you look at properties in center city areas, of those office buildings, retail and multifamily could even be challenged there as well. So you've got challenged cash flows, but you've also got higher rate resets. And you've got a lot of those coming due, and there's a big refinancing need. And we actually just put something out in the last few weeks measuring that, which we think there's about $1 trillion in CRE loans coming due in the next year, and that building over time. So as that paper is coming due, banks are being very careful, and they're facing tremendous scrutiny from the regulators in the investment community. And you're seeing loan growth there really slow. You're seeing okay trends on the consumer side. And it's kind of interesting because even as you see delinquencies rise, you heard just this week at the Barclays conference, some of the big banks saying that they'd like to expand their car portfolios. Again, something that you're hearing a lot of people worry about, car balances being at all-time high. But the banks are feeling okay there. You saw some blips in auto, and so you can see some pulling back there. But if you look at the core economy, C&I is holding up. You're not really seeing much cracks in the armor there. And one thing I mentioned about tightening standards, if you look at the Fed Senior Loan Officer Survey, the last one that just came out, there's some interesting trends there where you're actually seeing the percentage of banks tightening standards decline. Again, you tend to see reverse heading into a recession. You're actually seeing the prices on those credits decline relative to cost of funds. Again, you tend to see the reverse heading into recession, and you're seeing demand get better. All of them are still negative in terms of net balance. But if you look at those charts over time, you tend to see the reverse when we head into a deep recession. So that's somewhat good. One last thing that I would say is broad M&A activity. You don't see companies expand and do deals when they're nervous. If you're uncertain, you're not going to take a lot of risk. And there's tremendous uncertainty out there right now with not only the direction of rates, but the election. M&A activity broadly is still weak, but we are seeing some green shoots there, as well as some green shoots in terms of capital raising activity. So those are sort of things I'm looking at, how much risk are companies and consumers willing to take? And I'm not seeing anything that really terrifies me right now.
Excellent. I'm less scared already, Nathan. Thanks. So Tavi, I'm going to ask you the same question about beyond traditional indicators like CPI and PPI. What alternative economic indicators should investors and banks focus on?
Well, I think the yield curve is certainly a more conventional, but should be mentioned here as well. The steepening of the yield curve from a deeply inverted level is something that needs to be in your radar. It tends to cause volatility spikes. It tends to cause recessions, and so just empirically looking, if you're trying to really protect the portfolio during those periods after those deeply inverted levels, and you start seeing the steepening, which in my view is one of the most interesting, also macro trades and out there right now is the continuation of that steepening of the yield curve, especially on long end and the short end as well. Look interesting from both opposite directions, and so nonetheless, I think those are important. The other thing I would mention that it's happening actually right now, and I'm not seeing, I guess, enough people stressing this, but I've noticed, especially in the technology sector, that the breadth of the market is falling significantly. If you look at the 200-day moving average of companies right now that are below the 200-day moving average, that percentage has dropped drastically, and we're still seeing the index of technology near all-time highs, and so that's something to be aware of. And I would point out another one that I think it's very consumer driven, that is interesting too, is looking at the car loan rates versus the 5-year rate. And if you look at those two lines, what you tend to see is that they follow each other somewhat closely, right? I mean, if you're taking a loan on for an auto, and you're taking the risk-free rate, they tend to follow each other somewhat closely, although the car loan rate tends to be higher usually. What is interesting right now is that we had a decline of the 5-year yield, but the car loan rates remain, significantly higher, which I think it reflects as well on some fragility of the consumer. It's from a lender's perspective that you're seeing the concerns about having to keep rates slightly higher, despite the fact that the risk-free rate has declined. So it's something also to be very much aware. So those are the things outside of that I've been noticing more recently that I think add to the more weakness camp of the economy in the U.S.
The Rebel, before I go to you, I noticed as Tavi was talking about the car loan rates, Nathan, you were shaking your head in agreement. Is there anything that you want to add to his comment on that?
Yeah, just think there's real weakness there, and we certainly saw it, this past week with Ally putting out bad numbers that really spooked the market and really kind of led to a broad sell of bank stocks, because really every day everybody's waking up worried about credit risk, and so anytime there's any indicator there, one thing too though is the auto market just had such big disruption during the pandemic, with prices going so high and now coming back down. And the other thing I would kind of say is that it's an unusual market where it's very consolidated within U.S. banks, but there's a lot of credit unions very heavily competing there as well. So it is unusual, but that is the area that I am also concerned with. But the relative exposure to U.S. bank land is pretty consolidated among a few players.
Got it. So, Rebel, you were about to answer the question. Apologize for cutting you off there to give Nathan a chance to comment more on the car loans. So, why don't you share with us, beyond the traditional indicators of CPI and PPI, what should investors and banks monitor to better anticipate inflationary or deflationary trends?
Well, there's several that I'm looking at. First of all is credit card delinquencies, consumer credit card delinquencies. Credit card debt is at an all-time high, and delinquencies are spiking upward. They're not where they were in 2008, but that's telling us that the consumers are tapped out. They borrowed as much as they can, and now they can't pay their bills, and 30% interest rate. Another thing I'm looking at is the NFIB Optimism Index for Small Businesses, the National Federation of Independent Businesses. If you look at that chart, it looks like a total repeat of 2006 to 2008, the way it's falling. Index is just falling off a cliff. This is screaming that we're heading towards recession. What I'm really focused on, though, is I used to work in bank supervision for Chairman Greenspan at the Fed back in the 90s. I'm focused on commercial real estate and the NPLs and troubled debt restructurings in the banking sector. Troubled debt restructurings have risen by over 100% year over year, and NPLs are up sharply as well. There's a wave of commercial real estate refinancing during the next year, about $1 trillion. Most of these were 5-year balloon mortgages that were originated in 2018, 19, 20, 21. They're currently carrying rates around 3%. They're going to be refinancing at 7 to 10%. These properties are not cash flow positive as that sort of a mortgage, and so we're seeing this wall of foreclosures coming in the commercial real estate space. Now, it's really bad in office because office has been hit by the work from home double whammy, but they also face this refinancing wave. But the refinancing wave, it's going to hit all property types and all geographies. It doesn't matter if you're in Florida, it doesn't matter if you're industrial property, it doesn't matter if you're 100% leased. When that mortgage goes from 300 basis points to 800 basis points, that property is most likely going to foreclosure. And then the problem is that propagates because that property sells. We've seen these properties selling 50%, 70% haircuts. That becomes a comparable sale for appraisers and, more importantly, for bank examiners. So then the bank examiners are going to bank portfolios and saying, hey, you've got to provision for potential loan losses on your commercial mortgage portfolio. So this is all going to percolate through the banking system. It's going to have a very negative impact on access to credit, which is going to, again, pointing towards we're heading into a recession.
Rebel, you and Nathan are equally focused on the commercial real estate market and the challenged cash flow. Thanks for sharing that. Jim, how about you?
Well, I could breathe a sigh of relief because I had a couple of indicators in mind and they didn't get picked off, so I could discuss them right now. Since we're talking about PPI and CPI, I'll go with two. The Institute of Supply Management puts out a survey of purchasing managers, and they ask them a series of questions. One of the questions they ask them is the prices you are paying, your input costs, are they higher, the same, or lower than 3 months ago? That's the exact question they ask. And they put out a diffusion index. So 50 is equal number saying higher or lower. And that is a pretty good indicator from purchasing managers as far as input costs. If you look at they have both a manufacturing survey and a non-manufacturing survey. The non-manufacturing survey would largely be probably wages because you're talking about service companies at this point. Both of those are running at above 50, meaning that more companies are reporting that prices are going up than prices are going down. And that was a very good leading indicator back 2.5 years ago, that told us that there was going to be shipping problems because it spiked right before shipping costs spiked. And we had those bottlenecks coming out of the, when we were coming out of the lockdowns with COVID. Now, mid 50s is not a spike. I mean, it went, it could go as high as 100, meaning 100% of the respondents are saying that they're seeing higher prices. It got into the low 90s in 22, and it's in the mid 50s to high 50s right now. So that's not suggesting that there's any kind of a problem, but still more companies are reporting higher prices than lower prices. The second one I'll talk about is a little bit more nuanced, but it's very important for the Federal Reserve. And that's about what they call inflation expectations. And the Federal Reserve believes that this is a big driver of inflation. If you believe inflation is going to be higher, you're going to change your activities accordingly. So one of the measures they use in inflation expectations is the University of Michigan Consumer Confidence Survey. Within that survey, there is a question that they ask, what is your outlook for inflation over the next 5 to 10 years? Now, this gets widely reported on the median expectation for this survey, which has been really steady at around 3%. And a lot of people on Wall Street have said there isn't any inflation problem because it isn't moving. The median has been holding 293 for the last several months. But the University of Michigan on their website for their consumer confidence survey do publish, because it is a survey, a bunch of crosstabs. And if you look at the standard deviation, the mean, if you look at the interquartile ranges, in other words, within the data, what you're finding is there is wild disagreement about where inflation is going to go. The top 25% answers are just shooting off the top. You're getting some of the highest readings in the 45 years among the top 25% that we've ever seen. The bottom 25% are getting worried we're going to have deflation. So the median doesn't change. This is basic statistics here, but the interquartile range has been expanding greatly. And what that suggests is under the surface, there is no agreement at all as to where inflation is going to go next. This weighs heavily in the Fed's decision-making process when it comes to looking at inflation. Now, they're ignoring it for now because they're getting set to cut interest rates. But this will be a problem, I think, if it continues like this. And by the way, this whole disagreement, this is within the last 5 to 10 months. So this is not something that's been around for a while. So purchasing managers, prices paid in the University of Michigan survey on inflation, 5 to 10 year outlook.
Jim, when you first said that you had a few indicators that others had not mentioned, I thought maybe you're going to go to headlines. The headlines today are all over the place, including most recently that inflation is falling. In the last day or two, the headlines are suggesting that. And the inflation expectation might be influenced by many of these headlines, but we will see. And for those of you who are paying attention and you heard the reference to the University of Michigan, go blue. So I'm gonna skip over the employment indicators just for a moment that I said I was gonna go to. And since you mentioned the Fed, I'm gonna ask you a question about inflation targeting. Considering Chairman Powell's comment from Jackson Hole last month, how does the Federal Reserve's current inflation targeting approach align with the broader goal of maintaining economic stability? And will this approach be sufficient given current economic indicators? So, Tavi, I'm going to start with you.
Okay, well, I think that this mandate of the Fed is becoming more and more challenging, although it appears to be becoming easier. I actually think it's likely to be almost impossible. If I'm right about inflation actually staying higher for longer, and what concerns me, and I know some people have mentioned this as well, it is the interest payment relative to GDP is really eating into the fiscal stimulus. And one of the things I think a lot about is what caused this exceptional valuation of U.S. companies versus other places in the world. And I cannot think of anything that tied this more outside of technology than the exceptionalism coming from the fiscal stimulus that we've had in the US versus other places. And when you see the interest payment is starting to become 70% of the deficit, you have to wonder what the policy will look like from a Fed standpoint, from a fiscal standpoint. If we all agree here that the fiscal side doesn't have really a choice of continuing to or to actually create any sort of austerity or a plan to reduce the deficit problem, then we have to think about with the lenses of the Fed. What would the Fed then, mandate look like in the following years if interest payments are really eating into the spending of the government? And in my view, it comes down to the suppression of rates. And we don't know what policies will look like. History helps. And 1940s is a good example of that, of actually having to run primary budget surpluses and trying to suppress rates and all sorts of mechanisms that were used at that time. We can go back to the British Empire back in the early 1900s, restructuring the debt. All those are more radical changes. So none of us know what exactly will look like, but that to me goes back to the mandate of the Fed, because I think that the Fed is this inflation and labor markets stability mandate is going to be challenged by the fact that the interest payment will become more and more relevant discussion and actually merging the fiscal and the monetary side of policy in a big way. So I know this is a big answer, but I think it has a lot of implications in markets. I can't think of a world where if we do see something along those lines, that hard assets won't perform very well in that environment. So I'm constantly thinking about this as well from that perspective. So that's my 2 cents on the mandate.
Excellent. And for those of you who are watching the same screen that I am, it appears that Tavi is frozen and he's not practicing ventriloquism, just so that you are aware.
That's not good.
Rebel, I'm going to give you an opportunity to also share your thoughts on inflation targeting and the current approach.
Well, we know that the Fed has a dual mandate. They focus on inflation, they focus on employment and labor markets. We've heard Chairman Powell and other members of the FOMC say that they're switching their focus to the labor markets. And I'm wondering if this is premature. Does Chairman Powell want to be the next Paul Volcker, or does he want to be the next Arthur Burns? Remember that Arthur Burns back in the 70s famously started cutting rates too soon and let the inflation genie get back out of the bottle. And then we had Paul Volcker had to come in and raise rates to above 20%. We know that Powell failed to act on inflation during 2021 because he was seeking reappointment, which he achieved in April or May of 2022. Will he cut rates in September, 6 weeks before presidential election, and thereby politicize the Fed, as we've seen happen to the Supreme Court? It sure looks that way. Do the economic numbers indicate that the Fed needs to cut in September? No. Could they wait till December? Yes. So it's going to be very interesting. And the Fed also has multiple levers in its quiver. It doesn't just work on the Fed funds rate. It also has its balance sheet. And it had been cut in its balance sheet. I'm not sure where it is now, but I'm old enough to remember when the Fed's balance sheet was $800 billion, and last I checked, it was around $9 trillion. So it'd be interesting to know where is that going as well.
Thanks, Rebel. Jim?
Yeah, so the Fed's target of 2% might be getting a problem for them. So let's go back to May of 2022. Jay Powell was in the White House at the invitation of President Biden. And President Biden, this is back when the inflation rate was over 8%. And President Biden literally pointed at Jay Powell and said, America, this is the guy that's going to fix the inflation problem. Don't blame me, blame him, is basically what he said. And since that day, the Fed has taken it as an article of faith that they have to get the inflation rate down to its long run average or their long run goal of 2%. Now, what's been happening with that is there's been a big debate whether or not the Fed can get it down to 2%. And there's good arguments that maybe they can't. I happen to be in the camp that they can't, that they might be able to get it to 3. And that is a big difference between 2 and 3. But the Fed almost can't entertain that idea that they can get it to 2 because it would be almost admitting failure. So they keep talking about getting it to 2%. That brings up another issue. If the long run inflation rate is 2%, where is the neutral funds rate? When they start cutting interest rates next week, as I like to say, they're going to start a journey. What's the destination? The destination is neutral. What is neutral? If you ask most people on Wall Street where neutral is, they think it's somewhere between 3.5% and 4%. I happen to be more closer to 4%. The Fed's official target for neutral is 2.75%. That's up from 2.5%. And in June, when they raised that target to 2.75, Chairman Powell was asked about the long run target going up to 2.75, and he completely dodged the question. Oh, it's kind of a theoretical exercise, a thought experiment. Those are the words he used. It's not, don't really look at it as much more than that. Well, why is that important? Because if the Fed is going to start cutting rates and they're anchored on this 2% target, and so they think that the neutral funds rate is 2.75 to 3, they're going to cut rates 10 times, 10, 25 basis point cuts in the next year or so, and that's what the market's pricing. We have to ask ourselves a question. Is that going too far? Are they going to go so far and stimulate so much that they're going to produce an inflation problem on the other end? As Dr. Cole talked about, are they going to be, produce the same mistake that we saw Arthur Burns do in the 1970s when he cut rates too much, too fast, and then we had a secondary echo of higher inflation? It'd be one thing if the Fed were to cut rates to 4%. It'd be about 525 basis point cuts and hold there. But it seems like they're getting ready to go to this, target of 275 because they can't let go of this 2% inflation target because the president ordered them to do this in May in 2022. And they take that very seriously because it's one of the mandates of the Federal Reserve. So this inflation target thing is becoming a real issue for the Fed, and how they're going to work this out over the next year is really going to be important for financial markets and the economy in general.
Thanks, Jim. And Nathan?
I think those are all really good points. And the only thing I would add there is that I think the futures market has been a little aggressive. While the Fed has made the comments as Jim just outlined, and they're basing, it's not based on nothing where they're forecasting where rates will go. But if you look at late last year, we thought we had 7 cuts this year, and we thought we'd be there about now. We're not there yet. I think if you've heard some of them talk, FOMC members, I think they are familiar with the 70s and worried about it. So I've always thought, I've been in the camp for some time that I thought that maybe the market was getting ahead of itself on the pace of cutting, and that they were going to be more focused on killing inflation rather than worried about the economic impacts. I know that flies in the face of some of the statements that have been made from the Fed, as Jim just really outlined. But the last point I would make there, I think Jim laid out a pretty good case of why it would be challenging for them to kind of meet the level of cuts that some people are expecting, given what we've seen from inflation over the last 6 months.
Excellent. So I'm now going to go back to the employment indicators that I suggested to you I'd be discussing at the top of this discussion. With the updated BLS report indicating 820,000 fewer jobs than previously assumed, how does this impact the Fed's approach to monetary policy? And what are the potential implications for inflation forecasts and interest rate decisions? So, Dr. Cole, I'll start with you.
It's interesting. We have this revision, annual revision, where they say that 800,000 jobs actually weren't added to the economy. But that was really no shock for those of us who follow this, because just about every single jobs number that we've had in the last year has subsequently been revised downward, sometimes quite substantially. So it's not a surprise that when they finally do this benchmarking, we find out that a lot of those jobs didn't exist. One thing I really look at very closely when the employment situation comes out each month, first Friday of the month, is you get this headline number of 150,000 jobs. But then I immediately go and look and say, okay, how many part-time workers were added? So if you had 500,000 part-time workers, but only 200,000 jobs, then that means we've lost 300,000 full-time jobs. And that's really bad. And that's kind of what we've been seeing some in the recent reports. Another thing I like to look at is the number of workers holding multiple jobs. There's two surveys in the employment report. There's the household survey, which surveys households, the establishment, which is surveys establishments. We get the jobs number from the establishment report, the unemployment numbers from the household survey. But the household survey also has numbers on workers, and it doesn't count these multiple job holders. And we've consistently seen the household survey showing fewer workers than the establishment survey. So these are sort of things I'm looking at when I look at the employment reports every month.
Tavi, how about you?
In terms of the labor market, I think it's very tricky to, unfortunately, be using that as a indication of the business cycle this time around. And the main reason is because we can't ignore what's happening with immigration. Immigration is really changing how that data will look like. I mean, usually when you see the unemployment rate crossing its 24-month moving average, it's always been the case that we've had a recession and a further deterioration of labor markets. Now, I take that with caution because I really don't know if labor markets is the best way, most accurate of being looking at the economy. Now, one thing that I would point out, that despite what's happening with immigration, will probably be seen as weak data for labor markets, is the fact that when you look at further into the job openings in the U.S. and you look at how much of that is coming from government jobs, that trend is moving higher, and that's at the highest levels we've seen in many years. Usually, when you get to these levels, you're getting into a recessionary period. So yeah, that's a concern. I think that's something that maybe immigration might not be playing as much of a role into that data as other things. And so that's one other point. And then the other thing I would point out as well has been this lagging effect on the tightening cycle that I still respect. At least we can come up with why this time is different and all those sorts of things, but you have to at least it's the same thing as the yield curve. As an investor, you have to be at least cognizant of those things developing, and one of them is the fact that when it takes time for the hiking cycle and interest rates to actually permeate into the system, not only on corporate bonds and the actual cost of capital overall, but also particularly when you're talking about reissuing debt. And a lot of companies, as we know, have really levered up. I mean, I'll give you one example: the consumer discretionary sector, which is a very large part of the economy, as you all know. It looks to me, and I don't think I've ever seen that sector as levered as it has been from a debt to assets perspective. And so you would think that the reissuance of those commitments will eventually tie the cycle overall, and I think that will have an impact in labor markets at some point. So labor markets is the only thing in this discussion that I take with a little bit of less of a conviction because of this immigration trend. But I think there's some things to be, as I pointed out, to be aware of and to be concerned about, that are important to emphasize.
Jim, you started us off talking about labor markets, wages. When in response to my first question, I'm going to go to you to see what your thoughts are about this issue of the BLS report.
Yeah, I think Tavi hit the nail on the head. It's really about migration, and it's really about the population growth of the country. If you look at, let's start with the big picture. If you look at the population growth of the country, it has been declining, lower fertility rates in the United States for decades, and it bottomed at about 0.3% a year in 2020. It has now exploded higher to a 20-year high. Population in the United States is now growing at about 1.15%, or about 3.5 million people a year. 80 to 90% of that population growth is coming from migration. It's not coming from some kind of baby boom in the United States. Now, why is that important to bring up? Is because all the labor data that we look at is based on surveys that are adjusted for the population, and it's based on tax returns of people that have jobs with withholdings. If millions of people are coming into the country that are getting what the BLS refers to as under the table jobs, then it's really starting to wreak havoc on a lot of the labor data that we're starting to see. I'll channel my inner Goldman Sachs here. The 818,000 jobs that we saw being revised away, they estimate, and I think they're right in their estimates, that it was really only about 300,000 jobs that got revised down. The other 500,000 is that we replaced people that were getting jobs with withholdings with people getting paid under the table. So when they looked at the tax returns and they saw that people were getting more unemployment insurance and less people were paying into unemployment insurance, they assume that means that those jobs never were created in the first place. If the population growth of the United States was stable, that would be a good assumption. But because the population growth of the United States has been exploding higher for the last couple of years, it is a questionable assumption. That is also showing up in the unemployment rate too. One of the things that's happening with the unemployment rate is they do a survey of 60,000 households for the household survey. And they ask, how many people are working, how many people are looking for a job, and then they adjust it by the population growth. And because we've had this massive population growth in the last 4 years, it's showing up as higher unemployment rates. But don't confuse that with companies are hiring less people. That's why you see in the payroll report, we're still well over 100,000 people getting hired every month. Economists think that prior to the population growth spurt, we only needed about 80 or 90,000 jobs a month to meet demographics. But now, because of the population spurt, we're going to need like 200 to somewhere between 170 and 220,000 jobs over the next few years. Well, in order to get that level of job growth, you might have to stimulate the economy into a recession, into an inflationary push. This is the real problem. And I'll just leave it with, it all comes back to the population of this country has dramatically changed in the last 3 to 4 years. And it's permeating all the statistics. I might just parenthetically add that I think you're seeing that in the housing data. Most of the housing data looks very weak, whether you're talking about sales, affordability, except prices of homes is continuing to make new all-time highs. Why? We've got 7 million more people looking for a place to live in this new country. And it's really putting a strain on the housing stock, which is why prices aren't falling, even though everything else is falling. It comes back to that change of population growth. It's really driving a lot of the statistics we're seeing. And you question whether or not the standard definitions of, well, the unemployment rate's going up, so that means no one's getting hired. The revisions of 818,000, that means there's less jobs. That means that the labor market is weak. The Fed must respond by cutting rates. If that's really the right prescription and the right interpretation of what's happening, given this change in population growth.
Nathan, in response to my first question, you spoke about housing. Yeah. So I'm going to give you an opportunity just to react to Jim's comment there, and then talk a little bit about the BLS report.
Yeah, I mean, just one thing on housing is that the supply stock there is still really low. One of the things that happened in the aftermath of the Great Recession was we had overbuilt massively leading into it. So we had this massive inventory of homes we had to work through. And it took us a lot of years to do so, 3 or 4 years. But then we effectively underbuilt in the housing sector leading all the way up to the pandemic. So there is still a lack of supply, particularly when you talk about entry-level single-family homes. So, I mean, I think that's one of the things that I think has helped hold up home prices across the U.S. But I think Jim's point and Tavi's point about how messy this data is really underscores how difficult the Fed's job is. The unemployment data has been distorted, as Jim just outlined, I think, quite well. And what is the right sort of health of the labor market and how tough that is. And as Tavi talked about, the idea that the impact of higher rates hasn't really played out the same way we've seen historically, because I mentioned this at the opening, what we saw with consumers extending their duration with mortgages, but also corporates doing so in 2021 when rates were so low. It's not to say that it won't come, but effectively it's delayed the impact even further. So I just think both their points really underscore just how tough this is when trying to look at historical periods.
Got it. And since you're speaking, Nathan, I just want to go to the monetary policy limits. Excuse me. It's been touched upon in the answers to some of the other questions, but maybe there's more that each of you would like to share. Like, what are the limitations of monetary policy in addressing inflation, and how should economies prepare for potential policy failures? So, Nathan, I'll start with you.
Well, I just talked about some of the limitations, but the idea that the Fed sets rates and the banks are effectively the engine of how that carries out. And so when you have lots of people who borrowed when rates were low with fixed rates, you've effectively kicked out how impactful that can be on terms of tightening monetary policy. Here's the thing, the flip side of that also means how impactful they'll be in terms of lowering rates. So if you get a couple of cuts here, how much actual relief and impact does that actually have on the economy? And we think it's going to take a while on the way down. We talked about commercial real estate earlier, but I mean, the idea that, a quarter point cut changes anything there, I don't think so. I think you'd have to see dramatic cuts for that to look different. But I also think you have a lot of fixed rate debt outstanding right now. So even if you get rate cuts in the near term, that it will not come anytime soon. So, how do you prepare for that? I think be aware of that. And I think understand that, there's an old line in bank land, don't make rate bets. Don't sit there and wait on the Fed cutting to actually change the health of your portfolio and the health of your balance sheet. Certainly keep your eyes open, but understand the limitations here.
Dr. Cole, how do you feel about that?
Well, you have to consider monetary policy working hand in hand with fiscal policy. The Fed simply cannot control inflation when we have massive and reckless fiscal policy, as we have had for the last several years, where we're running $2 trillion a year annual deficits. So it's like a race car. You're putting your foot on the brake and on the accelerator at the same time. The Fed is, their hands are tied when this happens. And then now we have a situation where the Fed is contemplating cutting, but as I say, we're running these massive fiscal deficits, which are incredibly inflationary and expansionary. Is it really the right time to start cutting rates, given that the accelerator on fiscal policy is down pedal to the metal?
Jim, you want to react to that?
No, I think Dr. Cole's got it exactly right that you cannot exclude fiscal policy. And with the amount of spending that we're seeing and the deficits that we're seeing, that I like to, Wall Street is having this conversation about whether or not we're having a recession. And I always like to say, no, we can't with this kind of level of fiscal spending. At least a recession is defined as seeing negative GDP growth or some negative numbers that they will single-handedly create enough economic activity to prevent a recession. Fear, of course, is that they're going to create inflation along the other side. So it's not just all good and nothing bad. But the other limitation of monetary policy is, as the Fed likes to say, it's a blunt force tool. They can cut rates, but they're going to cut rates for everybody. And this really comes into with the housing market. I talked to a number of people in the housing market, mainly mortgage brokers, and they usually scream and yell and throw tantrums that, interest rates are too high and they can't get deals done because the monthly price or the monthly payments that people have to pay are too high. They absolutely need the Fed to cut interest rates. Okay. Well, the Fed can't cut interest rates for mortgage brokers. It has to cut interest rates for everybody. And that means they're going to be cutting interest rates in the corporate bond market and probably in the high yield market. And they're going to impact valuations in the stock market at the same time that they cut interest rates. And the totality of all of that, does that produce the outcome they want? They might satisfy the mortgage broker, but if they wind up creating a giant wealth effect in the stock market with lower interest rates, and they create a boom of corporate borrowing, they could wind up overheating the economy at the other side. So we got to keep in mind that I hear this all the time when people talk about the Fed should cut rates. And then I hear, because here's some narrow part of the economy that needs it, mortgages right now. Okay, they do. But they can't just say we're going to cut mortgage rates only and nobody else's rate. They cut everybody's rate or they cut nobody's rate. And there is the limitation of monetary policy.
Tavi, it's great to see you.
Good to be back.
Yes.
So
your thoughts?
I think that the limitation on the Fed front is interesting, just because the mitigation of inflation, of raising rates in an environment where I just talked about the interest payments really eating into the spending on the fiscal front is really prevents the Fed to do anything about it. And so the Fed has a choice to make, and given what the labor data is presenting to them, although I gave you so many and everybody else gave so many caveats on the immigration front and other things, the Fed may as well use that as a card to justify its actions. When I look at the 2-year yield today, I think we're going back to 2%. Now, this whole idea, and I know these are not T-bills, the whole idea of T-bills and chill that some of the media and investors were talking about maybe a year ago, I am very, very much of that view today. I actually think that that's a very interesting way of protecting your portfolio if you are of the opinion that 2-year yields, especially in other yields, are going to drop significantly. It would not surprise me to see 2-year yields back to 2%, which is a very, very significant change from where it is currently. Another thing that I think reflects on the Fed limitation of fighting inflation, but also the divergence of policies between the Fed and the fiscal side, look no further than the central bank assets chart versus money supply. Money supply has been resurging recently, and at a time when we're still seeing the QT, the depletion of reserves occurring in the Federal Reserve balance sheet assets. And that's, again, a reflection of the system that doesn't allow that type of monetary tightness, that through the fiscal stimulus as well continues to add to that money supply front. And, this is why I think it's very difficult to wear a deflationary hat in this environment, because, the limitation as well from the macro imbalance that we have historically on the debt front doesn't allow the Fed to truly fight inflation as it probably would in a normal cycle as well. So again, it's almost the end of the day, it's almost like we tend to see more and more monetary suppression, and the translation of that is on the data by looking at money supply resurging and others. And so this is why I think an inflation camp remains, in my view, underappreciated still. And it sounds crazy. I mean, how can you have an inflation view with 2-year yields falling? I know, I understand, but I think it's very possible to see that in the next 12 months or so. And so I'm of that view.
So Nathan, you suggested at the top of this that consumer spending was one of the factors we should be focused on over the next 12 to 18 months. So tell us a little bit about your thoughts on consumer behavior that we should be focused on that could typically lead to inflationary versus deflationary impulses. And what have you seen from the U.S. consumer in the last 6 to 12 months in that regard?
Well, certainly the consumer is stretched relative to where they were a year ago. And, I mentioned the idea of looking at savings rates. You've seen those come down considerably. They're not at zero, but it definitely is worth looking at, and also maintaining a focus on wages relative to inflation, as Jim talked about earlier. So the fact is they are still saving some money, but as I mentioned, they're relying on cards in no small part to maintain some of that spending level. Rebel talked about this earlier. We are seeing delinquencies on cards go up dramatically from historical lows. We hit a trough, I think, in October of 21 when you look at the major card issuers there in terms of delinquency levels. But two things I would point out. If you look at what the pre-pandemic average was in those delinquency rates, we haven't hit that yet. So all those card companies will tell you that this is more normalization. The jury is still out there. But the other thing I would say in Q2, we actually saw a sequential decline in those level of delinquencies, and that's the first time since early in 22. That doesn't really speak to a consumer getting really out of control and really, really over their skis. Still a little bit early, but stabilization, I think, is pretty encouraging there. And one other thing I would note too, we heard from Bank of America this week, one of the things they do is they look at not only their consumer spending, but the balances that their consumers keep in accounts. And remember, they hold 10% of the nation's deposits. So they have a decent window into what that looks like. And Brian Moynihan had said, it's down from what it was a year ago, but they've seen some stabilization in the last 6 months there in terms of the level of balances. So they're not drawing down more. So early days, it could get worse for sure, particularly if you see the labor market weaken, but somewhat encouraging trends there in terms of stabilization.
Rebel, I'm going to ask you a different question focused on credit risk management, since Nathan really invoked that from an earlier comment that you made. So how has inflation affected credit risk over the last 12 months, and what do you expect to see over the next 12 to 24 months?
Well, before we go there, I did want to jump in on consumer behavior because a story I saw on the financial networks a few days ago. The stock price of Dollar General is down almost 90% this year after skyrocketing during the pandemic. So what does this tell us? It tells us that those at the bottom of the economic ladder are tapped out. Inflation has ravaged those people at the bottom half, but it's done little to hurt those of us at the top. All right, so now credit markets. We're starting to see the impact of inflation and its impact on the economy enter into the credit quality of the banks. I've already mentioned the rising troubled debt restructurings and non-performing loan rates at the commercial banks. The non-performing loans, they report them in several buckets. One of them is 30 to 89 days past due, and then there's longer term. And that 30 to 89 day bucket is what I keep my eye on. And that has been rising much faster than the total NPL ratio, which tells us that the situation is getting worse in the commercial real estate market in particular, but not just in the commercial real estate market. I also mentioned what's happening with credit card delinquencies. We're seeing, the fact that those at the bottom half of the income level, they got the big COVID money from the government during the pandemic. That dried up. They maxed out their credit cards, kept spending. Now they're unable to service their credit cards, and that's showing up in delinquencies, which tells us that they're tapped out. And that has some very negative connotations for what's going to happen with consumer spending going forward. But it also has implications for what's happening in the credit markets as far as credit quality of these credits. So I think we're going to see a lot more deterioration in bank balance sheets during the coming year, and that means they're going to be clamping down on credit, because when they have high NPLs, then they have to provision and they can't lend.
Tavi, if you want to comment on the consumer impact and credit risk management, you may. But I'm also going to give you another topic to focus on, since you began discussing the U.S. dollar and imports earlier on in the discussion. And how does inflation impact investors differently in emerging markets compared to developed economies? So you can take any one of those three topics. Just want to get your thoughts on that.
Well, I'll take the emerging markets because I think it's such an important, trend that is not also have not been impacted in markets just yet. And AI leveling the playing field from a labor quality standpoint is a very important deal. That when you think about this differential evaluations of companies in the U.S. versus other places I come from Brazil, so I can speak a little bit more specifically about that. It's been very challenging. I mean, the Brazilian economy, South American economies, and other emerging markets have always dealt with inflation. Inflation has never left the picture. So they deal it differently with it, and they're very fast on acting from a monetary standpoint and even fiscal standpoint when it's necessary. Different from developed markets, in my view, that lack a little bit of the understanding of how policies still can add to the inflation front. I mean, this idea of an Inflation Reduction Act and all these things are, to me, classic signs of lack of understanding of inflation in the system. And it's just a reflection of the fact that we just haven't dealt with the problem for many decades. Now, I think that emerging markets present an outstanding opportunity today, and mostly because it's tied to the commodity markets. When you look at the charts of industrial base metals and metals in general, or even energy markets versus specific resource rich emerging market economies, obviously they're very linked. So if you're of the view of a dollar weakness, which I am, and you're the view of a secular market for hard assets, you are also probably of the view that emerging markets can actually outperform developed markets. And these things, every couple cycles, or I should say every couple decades, they change. The leadership, before the tech bust in the early 2000s was also very prominent coming from the US. So you had allocation of foreign investors being very heavy in US equities, and then that shifted. And so you look at Brazilian markets from the early 2000s to 2011, they went up 18-fold. The most boring index, Ibovespa, if you just bought the Ibovespa the early 2000s and held it all the way to the end, that was an 18-fold return. These are not small returns. And so although all of them carry risk and markets change prioritization towards risk in different times, I'm not here to say that, Brazil has been in emerging markets for decades and never emerged to become a developed economy. And that's not just Brazil. A lot of emerging markets have been emerging for decades and never emerged to become developed economies. There is a reason for that. There's fundamental reasons that don't allow those economies to change that profile. But one doesn't preclude investors from making money on assets that could, take on that leadership again. As I said, that cycles change, and every couple decades you have these shifts on, one economy being favored versus another. And so I think we're kind of in that inflection point today in emerging markets. And so hence why I pay close attention here. You have legacy businesses, banks and financial companies that are trading currently at, lowest multiples we've seen in history. So the inflation question you asked, although it's important, I don't think it will really impact the emerging markets, valuation of assets as deeply, just because it's not a new problem. It's something we've dealt with many decades. And so, in fact, the consumer is different. I would even point out even one more thing, if you don't mind. Look at how the investors are created in these places. They're very, very value driven. They're very much aware of cost of capital. They're very much aware of discounting free cash flow and all sorts of ways of valuing companies. In the US, that seems to be thrown out the window for a long time. The growth investing versus value investing debate. It's not even a debate in the last few years. Now, I do think we'll come back as we see cost of capital establishing itself at higher levels than we've seen historically. So there are a lot of important lessons in emerging markets, not only opportunities, but lessons that we need to apply in the US, trying to understand how that will impact markets in a big way. I gave some thoughts already, but I think I could go on and on other ideas that could potentially be changes in this landscape of the macro environment in the US versus emerging markets.
Thanks for that. And I want to be respectful of the time that our panelists have allocated for this discussion, and let our Optimum Bank friends know we're going to run a little bit over, because I'm going to give each of them an opportunity to share some final thoughts for the audience. So, reflecting on today's discussion, what is the most critical factor that banks and investors should focus on in the coming year to navigate the complex interplay between inflation, monetary policy, and market dynamics effectively? So I'm going to go in this order. Since Tavi just spoke, I'll give him a chance to clear his throat, and we'll start with Rebel. We'll go to Tavi, Nathan, and then we'll close with Jim. So Rebel?
I know we're short on time, so I'm going to keep it short and sweet. I've already touched on this. The most important thing to keep your eye on is the interplay between monetary and fiscal policy. These need to be working together in order to avoid recession and inflation. Fiscal policy is stuck in a massive and expansionary inflationary mode. You simply cannot fine-tune an economy using only monetary policy. The instruments are too blunt, the legs are too long. We must get our fiscal house in order, and it doesn't look like either of the parties have any intention of doing that.
Tavi?
I'm actually going to agree. I think that the fiscal side is the most important thing, the most important aspect of everything. Potentially what we could see here, the changes because of the interest payments eating into the fiscal spending to me, needs to be more discussed. And the fact that if you looked at how much that is today, and the conversation used to be, yes, things are bad here, but things are worse outside of the US. And it's not necessarily true, those comments. When you look at the interest payment relative to GDP of the US, running between, 3 to 4%, depending if you want to include local governments or not, versus other countries in the world, sub 2%. That makes me think that the readjustment of the rate policy in the US will likely be more severe than other places in the world. And that interest rate differential, in my view, will have an impact on the dollar. This is why I'm so focused on the dollar, but it ties back to the fiscal ending. So that's my 2 cents on this.
Got it. Nathan?
I'll
And Nathan,
build
actually, before you start, you made a comment when we first opened up that I was muted. And what you did not hear is I thanked David for the amazing introductions that he gave of each of you. And I didn't want to miss this opportunity to restate that so that everyone could hear it. Nathan.
Well, I'll build on those statements and echo what Tavi and Jim had said earlier about inflation maybe being stickier than people think. And what are the implications for rates there that maybe we can't go as low as people think? I think that's something that you need to watch closely.
Got it. And Jim?
Yeah, I'll second that, what Nathan just said, that it really comes down to the inflation rate is much higher than anything we've ever saw pre-pandemic, but it's also the lowest levels that we've seen since 21. And where's it going to go? Are we going to eventually get to 2%, under 2% and stay there? And I might add, do it without a recession. If you have a recession and you weaken the market economy enough, sure, you can get the inflation rate down, but it will only stay there as long as you're in a recession. I don't think we will, but that'll be the big question as we move forward is where does the inflation rate bottom out and where is it in a year or so? And I happen to think it's going to be around 3%. And I'll just reiterate the other thing I talked about too, and which come up with other panelists, especially with Tavi, is immigration is a big deal. It is impacting the economy through the changing population growth of the economy in ways that we're only beginning to understand now. And we have to be careful of traditional answers. Well, this is happening in housing. This is happening with the unemployment rate. So therefore, it must mean, well, we have to start thinking, is it because the population of this country is growing at much higher levels than we ever thought possible, even a year or two ago? Or is it really giving us more of that traditional signal? This is going to be a difficult question to answer over the next year, but it needs to be considered. And we just can't look at this data that is wrapped up with population growth at face value.
Well, gentlemen, thank you very much. Really appreciated this opportunity to discuss these topics with you. And I'm going to now turn it over to Chip LaMarca.
Well, good afternoon, almost afternoon. My name is Representative Chip LaMarca, and I proudly represent House District 100 in the Florida Legislature. Optimum Bank is but one of the many thriving businesses in our district across our great state. And this motivates me to keep working tirelessly to enhance the lives of my many constituents and fellow Floridians. I'm grateful for the chance to be with each and every one of you today. And as you conclude the inaugural Optimum Bank Virtual Banking Conference, it is my distinct honor to introduce our closing speaker, Sheila Bair, who has a long and distinguished career in government, academia, and finance. Sheila has served as the chair of the Federal Deposit Insurance Corporation from 2006 to 2011, guiding the agency through the worst financial crisis since the Great Depression. For her tireless efforts to protect bank depositors and homeowners during this challenging time, she received the Kennedy Library's Profiles in Courage Award and was recognized by Time magazine as the little guy's protector-in-chief. A former finance professor and college president, Sheila is also a frequent commentator on financial regulation and the student debt crisis, and the author of the New York Times bestseller, Bull by the Horns. Currently, she serves on multiple corporate boards and is a founding chair of the Systemic Risk Council, which really caught my attention as a kid growing up in the 70s and 80s that she was regularly published in Highlights magazine. Please join me in welcoming Sheila Bair as she shares her insights on the future of banking and the critical challenges we all face.
Great. Oh, thanks, Chip. That was a very kind introduction. What a great conference. Optimum's really, this inaugural event has really been outstanding. Such distinguished speakers, insightful comments to help us all understand and navigate what is a very uncertain future for the economy, as well as our banking system. So thank you to Optimum for putting this together. You've given me the unenviable task of closing the conference with so many hard acts to follow with the speakers lineup, but I will do my best. I was asked specifically to talk about the interest rate environment and my views on the prospects of future rate cuts, which is obviously top of everyone's mind and has dominated this conference and a lot of other commentary currently. I'm going to tell you what I think will happen, and I'm also going to tell you what I hope will happen. I think they may be two different things. But first, I'd like to make some observations about what's missing from the debate over interest rates. We talk too much about cuts as if they were an intrinsic good. But in point of fact, there's very little, if any, research showing that low rates correlate with strong labor markets and economic growth. Historical experience suggests the opposite, with periods of low rates characterized by low productivity, sluggish growth, increased corporate consolidation, wealth inequality, and of course, a buildup of destabilizing leverage. More normalized rates bring greater discipline and capital allocation, which in turn increases productivity and more robust economic growth. At the Main Street level, more normalized rates give households a safe place to keep their savings where they can earn a decent return. Pension funds, endowments, insurance companies, traditionally risk-averse investors, as they should be, can also allocate more of their investments to safe assets instead of being forced to disproportionately load up on riskier assets. Wall Street, a lot of parts of Wall Street make a lot of money when interest rates go down. They make a lot of money, more money when we put our savings into risk assets versus those nice, safe, stodgy bank deposits or money market funds. And of course, the value of their financial assets get a nice boost. So I think these benefits to a lot of parts of the financial sector skew the larger debate and cover and camouflage what are some very positive things about keeping rates higher. Low rates are also bad for traditional banking. When rates are ultra low, certainly near zero or negative, it's pretty hard to make money on interest margins. So I think traditional lenders should be cautious about adding their voices to the Wall Street clamor for big cuts. To be sure, those who have unrealized losses on their securities portfolios will see a nice boost in the value of those assets, but their core business could be challenged if the Fed goes too fast. We've finally seen a normalization of the yield curve, barely, at least between the 2 and 10-year treasuries, but bills are yielding over 5%. And given the Treasury's voracious appetite for short-term borrowing, those rates may stay high even as the Fed cuts. T-bills and the money market funds that invest in them are directly competitive with bank deposits. So with big rate cuts, your loan yields may well go down, but you will still face significant competitive pressure on the rates you have to pay on deposits. And most importantly, it is still too soon to declare victory over inflation. Yes, commodity prices have come down, providing a headline CPI rate of 2.5%, but commodity prices are highly volatile, particularly energy. Core inflation is still north of 3%. Housing inflation has proved persistent, and lower mortgage rates will only exacerbate supply-demand imbalances. The worst-case scenario for both banking and the U.S. economy is a stagflation scenario where the economy slows, but inflation and thus rates have to remain high. We must avoid that scenario at all costs. Fortunately, at this point, while the economy is slowing, I think the labor market still appears to be in pretty good shape. Granted, the numbers we're using these days are imperfect, particularly given the massive wave of immigrant workers in the country. But based on the data we have, job gain, it looks okay. Job gains were below expectations in August, but still a pretty healthy 142,000. Unemployment ticked down. Average hourly earnings increased by 3.8% annualized. This looks like a soft landing to me and suggests cautions against the Fed doing anything too drastic. And clearly, while lower rates will give a boost to Wall Street, will the benefits trickle down to Main Street? The stress we are starting to see, particularly among lower income households, I don't believe is a function of high borrowing costs. It's a function of prices which are 20% higher than they were in 2020. And that inflation is higher. The increase in the cost of living has disproportionately hit low-income families even higher. So they're dealing with this, plus the dissipation of some stimulus monies. That's what's stressing that segment of our population. Precipitous rate cuts are unlikely to trickle down to their benefit, but precipitate cuts do risk a resurgence of inflation, which will harm them significantly. So I think actually a fair case can be made that the Fed should stand pat next week. I don't think that's going to happen, but I would make that case. At most, it should cut by 25 basis points. And I hope that the Fed also cautions the markets that further cuts will be dependent on future inflation data. I hope Jay Powell, at least, walks back his highly dovish comments at Jackson Hole. Every hint of future cuts from the Fed will create exaggerated expectations by the markets, easing conditions before the Fed even acts. We've seen that over and over again. This is exactly what happened late last year when his dovish comments took market rates down, contributing, I believe, to a resurgence of inflation in the first quarter. His rate-cutting finger may be a bit itchy, but it's better to underpromise and over-deliver later on rate cuts if the data supports it. I have tremendous respect for the Fed, but its reputation and Powell's legacy, I think, will be defined by whether they are successful in actually slaying the inflation beast. And I think Chair Powell definitely wants to achieve Paul Volcker iconic status. He will not achieve that by bowing to market pressure to cut precipitously. The consensus projection is 25 basis points next week, with 2 more 25 basis point cuts before the end of the year, and 200 basis points total cuts by the third quarter of next year. I think 75 basis points total by the end of this year is likely, but I will take a wait-and-see posture of further cuts next year, mainly because I think the continuation of fiscal inflationary pressures will increase, and that's regardless of who is elected president. Fiscal policy will continue to be inflationary, countering any efforts that the Fed will try to make. So in sum, I hope we can make a more balanced public debate about monetary policy with greater recognition of the benefits of higher rates and a challenge to the assumption that lower rates somehow are necessarily going to benefit working families. I don't see it. And for community bank lenders, I do believe maintaining a more normalized interest rate environment will be a good thing because above all, lower and middle income consumers and small businesses, and these are the engines of our U.S. economy, they rely on a vibrant community banking sector to meet their financial needs. So thank you for the privilege of providing some closing comments. I hope I've given you some food for thought. Again, thanks to Optimum for inviting me to close this amazing conference that ends our program. Thank you so much for attending.